Good morning, friends. I welcome you to this fourth and the last day of our refresher course on Ind AS practical aspects. Presently, friends, I believe everybody is safe, healthy, and I would request on my personal behalf and on behalf of all professionals that please take care of yourself and maintain all the safety measures that are required. Friends, today we have with us our expert speaker, Yagnesh Desai, who is going to take us through Schedule 3, Division 2, and also give an overview of the Ind AS 8. I welcome Yagnesh to this platform. Friends, we
Namaskar ji,
also
welcome
have
to all
with
of
us,
you. Thank you, C. Good morning and happy Holi to all of you.
yeah. So, friends, we also have with us CA Archit Antani, who is the coordinator for the day. I would request Archit to kindly introduce Yagnesh Bhai.
Thank you, sir. Good morning, everyone. It is my pleasure to introduce very known faculty from Mumbai, CA Yagnesh Desai. Apart from CA, he is also a CPA from USA. He has been in practice for more than 3 decades now. He has vast knowledge in the area of corporate laws, accounting and auditing standards and Ind AS. He is also very actively engaged with the ICI. He is faculty and trainer at various forums and certificate courses conducted by the ICI. He has conducted various seminars on Ind AS, accounting standards and auditing standards. This is, I guess, his 986 session, which is quite remarkable. With this short introduction, I request sir to take charge of the session.
Good morning, everybody. Good morning, Vishalji, and good morning, Archit, and all the participants. And let's start. Thank you very much, Vishalji, for giving us an opportunity to dwell upon this Schedule 3, which is much talked about. And without waste of time, I'll straightway go to the subject. Just a minute, please. I'm making this okay. Now, friends, have you seen that recently there have been before that I must share the breaking news, and for that the credit goes to the Vishalji, that recently there have been changes in the Schedule 3 requirements, and those for that WRC has acted very actively, and they have set up a program on 1st of April from 5 to 7 p.m. This information has been shared to me by Vishalji, and that's why we are not going to debate on this point, but we in general discuss about the Schedule 3 to the Companies Act. Friend, Division 2, Schedule 3 to the Companies Act deals with the Ind AS financial statements. When I say financial statements, excluding statement of cash flow. These are the few minor points I want to start very lightly, so that kind of a very good warming up, and these are very pretty light point to discuss about. As we know that as far as the dividend on the preference shares are concerned, since they are being treated as a liability, they are not being classified as a dividend, but the dividend paid on the preference shares is to be classified as the finance cost. And as regards the rounding of less than 100 crores and more than 100 crores, it is a shall, it's a must, as against in Division 1, where there is an optional, but there is no option here. One more thing, the finance cost in case of the defined benefit obligation, where there is a finance cost or a employee cost. In this case, the guidance note paragraph 9.5.5 gives a guidance that the interest on the defined benefit obligation as a result of the unwinding or discount to be treated as a finance cost rather than an employee cost. So this is very interesting thing which I have discussed with Vishalji, and he has again said that Yagnesh Bhai, yes, it is worth discussing tomorrow, and I got endorsement of the Vishalji also. Friends, when it comes to the Ind AS, normally we focus on the standalone financial statements and the consolidated financial statements. Yes, sir. And in fact, abroad, the focus is more on the consolidated financial statements than the SFS, these standalone financial statements. I want to bring this to your notice, and is a very typical requirement of the disclosure. This is concerning the financial assets. Now, if you see the financial assets in the standalone financial statements, they are classified under the financial assets. the investments in associates, investments in JVs, and investment in subsidiaries are classified under the financial assets, under the category of financial assets. But the same investment, when it comes to the consolidated financial statements, as we know that investment in the subsidiary gets knocked off, that's fine. Now there are two investment which remains, which is the investment in associates and investment in joint venture.
Yagnesh bhai, sorry to interrupt, but is there any screen that you need to change? Because right now we are seeing just the 1st April slide.
Oh, you pointed out correctly, but I'm changing here at my end, sir. I'm changing here.
No, I would suggest you can do a stop share and select that slide. Yeah, now we can see. Now we can see. Yeah.
Okay. Thank you. Thank you, Vishalji, for pointing out this error. Okay. Or the lapse, or whatever you call it on my part. All right. All right, friends, when it comes to the investment in subsidiary associated JVs, as we know that as regards the consolidated financial statements, investment in subsidiary gets knocked off. Now, there remains two category of investments: A, investment in associates, and B, investment in JVs. Both these are now accounted using the equity method. So as regards the presentation of these two investment in the financial statements, more so in the balance sheet, they are not shown as a part of the financial assets, but they are shown outside the financial assets. So this is very important care one is to see, one is to keep in mind. And I have shown something here, whereas this is the statement, this is the standalone balance sheet, and in which you'll see the Sergi, can you see the PDF file financial assets? Vishalji?
Yes, yes.
Is it visible clearly, or
maybe you can zoom a bit?
I've tried the maximum, sir. The control plus.
Okay, fine.
Okay. So guys, come closer to the screen, please. You can see the investment in subsidiaries and JVs and all these are shown, presented under the financial assets in the standalone financial statements. But when the same investment when the same investment, same company, you can see it's being presented outside the financial statements, and this requirement is given by paragraph 8.1.8.4. I repeat, 8.1.8.4 of the guidance note, and paragraph 57 of Ind AS 1. So this is one thing you have to be very careful about, and don't try to present it under the financial assets. If you read this paragraph, you will really understand that what is the logic. In a nutshell, the logic is about the logic is concerning the definition, inclusion and exclusion of these investments. I don't want to dwell much, but please refer to this paragraph of guidance note to the schedule division 2, schedule 3 to the Companies Act, 8.1.8.4 paragraph number. Okay. Now, again, sir, when it comes to the disclosure of the financial instrument pursuant to paragraph 8 of Ind AS 1, investments in the amortized cost, you have to classify the investments as per the investment measure at fair value, FVTPL, that is fair value through profit and loss account, fair value through other comprehensive income, and amortized cost. So I'll just try to see whether this works here. Investment, yes, it does. Allow me a minute, I will rotate it, sir. So this is something which is very tricky, and those who are dealing with the financial instrument, friends, sir, can you see the PDF Atul file, sir, before you? Hello?
Yes.
Okay. Now you see that this category is required to be presented, to be disclosed pursuant to Ind AS 107. Now you can see there are three categories: FVTPL, FVOCI, and an amortized cost. It's very obvious that dividend receivable, cash on hand, and all these are being presented amortized cost. In one of the balance sheets, I have seen equity instrument, both categories: A, FVOCI, which is the fair value through other comprehensive income, and amortized cost also. And I asked the management, I said, what's the reason of doing so? He said, Mr. Desai, the reason is that we have we have resorted the exemption given and pursuant to Ind AS 27. Let me share this with you that Ind AS 27 allows the investment in A subsidiaries, investment in associates, and investment in JVs, which may be carried subsequently at the cost. But initially, all financial instruments have to be measured at the fair value pursuant to Ind AS 109. But when it comes to the subsequent measurement, Ind AS 27 allows two options: A, at cost, and B, at pursuant to Ind AS 109. So that company has decided and opted to measure the equity investments for the subsequent measurement at cost pursuant to Ind AS 27. But mind you well, equity cannot be and should not be classified as amortized cost. I understand one can get eclipsed and carried away by the fact that the equity is measured at cost, but that does not necessarily mean it's an amortized cost. Amortized cost can be used only for the debt instrument and not for the equity instrument. So then what's the remedy, sir? Then how do you disclose it? These are not supposed to be disclosed or disclosed because they are not covered by Ind AS 109, but the presentation of the disclosure is covered by Ind AS 27. And hence there was no need to classify and mention the equity instrument in the category under the amortized cost. This point I really wanted to bring to your notice, so I thought let me discuss with you. Okay, now the share application money, if its allotment is almost decided, then it's a part of the statement of changes in equity. But if the share allotment money is to be repaid, partly is to be repaid, then it will never form part of the statement of changes in equity, but rather it will be presented on the face of the balance sheet either as a non-current financial liability. Sorry, this should be used as a liability and not as an asset, right, sir? Now this second part is the investment made by you. The first part is the about the liability. There are two parts of this investment. Center number one is concerning the company receiving the application money. If it is assured, then it will be a part of the statement of changes in equity, otherwise current liability, because as per the Companies Act, within 15 days of the within 60 days the money has to be repaid. But if you have made an investment, in the share, then it will not be a financial instrument, but it will be other financial assets and other current financial asset or the non-current financial asset, as the case may be. But it will not be defined and classified as a share. Just keep this in mind. The second part is concerning the investment made by the entity. And very frankly, sir, as far as current contract liabilities are concerned, I have seen that there are different ways of presenting the contract liabilities. Now, contract liabilities pursuant to Ind AS 115, where you receive the money in advance, when the entity has received the money in advance from the customer, but it is yet to perform. So here also I put the page numbers of two annual reports just to show that there are various mixed practices. As far as Atul Limited is concerned, it is presented on the face of the balance sheet, page number 104, and okay, just a minute, sir, page number 104. Yes, as far as this company is concerned, it is presented on the face of the balance sheet, the contract liabilities. Can you see the contract liabilities presented on the face of the balance sheet? Whereas when it comes to the Larsen and Toubro, it is, let me see which page number, sir, please allow me a minute. It's page number 397. So this is just to give an idea that there are, though the standard, sometimes standard is not very clear about where to present or whether to disclose. When I say present means showing on the face of the balance sheet, and when I say disclosure, it means it is forming part of the notes to the accounts. Can you see the contract liability? Arpit Bhai, can you see this? Hello? Arpit Bhai, can you hear me? Hello?
Yes, we can see that.
Okay, you can see. So these are the mixed practices being followed. One company is presenting, the other company is disclosing. Same is the case with when it comes to the LNT, the right of use asset. they have presented on the face of the balance sheet, whereas some companies do not show on the do not present on the face of the balance sheet, but rather they disclose. So let me see and show you here where they have presented on the face of the balance sheet. Can you see the right of use assets? Can you see, sir, friends? Can you see the right of use asset? It's on the
Yeah, we can see that.
face of the balance sheet. Whereas when it comes to the Atul Limited, it was showing as a part of the notes to the accounts. So it in many companies follow the different practices. That both are permissible. Now I have seen in couple of balance sheet that the advance given for the capital work in progress have been shown wrongly as a part of the capital work in progress or the other non-current. So the question is, should it be part of the capital work in progress or the other non-current asset? The answer is that capital advances never form part of the capital work in progress, but rather it is other non-current assets. Be careful about this, friends. At the same time, the trade receivables and receivables other than trade receivables, you need to bifurcate and understand the difference between these two, and accordingly you should make the presentation. For example, if you sold an equipment or other than the ordinary items which have been produced in the ordinary course by an entity should be treated as other receivables and don't mix up as the trade receivables, but such receivables rather should be classified as other financial assets, and each you should disclose the nature. But essentially, you should differentiate between these two. Friends, you may some of the stalwarts may feel that why is Yagnesh Bhai is talking such a rudimentary and the basic things, but sir, in the process of making the research on about 125 companies based on the financial year 20, we found out because we wanted to enrich ourselves with the various and the best practices followed in the industry. Um, at that point in time, we came across certain financial statements, and I'm sharing my experience with you. This does not necessarily mean that you are making such mistakes. And pardon me if you feel wrong about it, if you feel it's too simple about it. I hope, Vishal Bhai, is it? Hello, Vishalji?
Yeah, I am here.
Yes. I hope you agree with my strategy that some students, some participants who are stalwarts, well experienced may think that this is a very simple and very rudimentary thing, but I think it's important to dwell upon this. What's your opinion?
Yeah, true.
Okay. At the same time, we've seen that the contractor said the standard. In fact, I went to the standard today morning only, and to see that it is to be presented in the balance sheet is aligned separately from the trade receivables contract assets, because contract assets are different from the trade receivables. These are pertaining to the works contract, wherein you received when you have rendered some services but you yet to bill. In some cases they were unbilled revenue. In past they were using the phraseology unbilled revenue, but now the new phraseology is a contract asset. But I'm yet to come across any company which is showing this contract asset on the face of balance sheet. And I'd like to share, I'll request Vishalji to share his views. During last 15 minutes, that if he has come across any balance sheet or if he wants to dwell upon the contract asset, will be more happy to have the words of wisdom from Vishalji. Okay, but this is again in last 15 minutes time. This is again a current tax refund. I've seen many companies being shown as other non-financial assets, IT refund, but this is a specific requirement given in the Division 2, Schedule 3 to the Companies Act, that the excess tax paid should be shown as a current tax assets. Well, in India, sometimes it is non-current asset also. And this is the presentation by the lessee in case of the lessee. So this is from the perspective of the Ind AS 116, the standard which has been changed drastically only from the perspective of Ind AS 116, only from the perspective of the lessee. The right of use asset is separately shown for the other asset. As we can see, there are two modes of presentation. It can be presented or it may be disclosed, and it can be clubbed with other line item, other item also. For example, you have your lessee under 116 for a building. So there are two options. Either you show it on the, either you present on the face of the balance sheet, ROU asset building, or you disclose the notes to accounts, which is forming the part of the PPE. And then if you are showing it along with PPE building, then you need to disclose in the notes to accounts as to the ROU asset dash building is forming which part of the asset, including the line item. But mostly people prefer to present it separately. And lease liability, again, from the separately from the other liabilities. Some entities are presenting as the financial liabilities, some borrowings. Some companies are presenting in the borrowing, and some companies are showing as the other liability. They're the mixed performance, mixed practices followed by the various entities. When it comes to the statement of profit and loss account, interest expense is on the lease liability, again has to be presented as a separate line item, not necessarily on the face of it, but in the schedule forming part of the finance cost. Depreciation, again, part of this. Now, when it comes to the financing activity, when it comes to the statement of cash flow, the interest and the repayment of the principal as both presented as a part of the financing activities. But mind you well, there's one catch here. If you have claimed the exemption, that means if you're not showing the if you avail of the exemption, like the short-term leases or the low-value assets or the variable lease payments, which are not forming part of the lease assets, lease payments, then such payments are to be presented as a part of the operating activities, though it is not covered strictly by the no strictly covered by the Schedule 3 Division 2, but I thought let me prevail upon it and then disclose this. That okay. Archit bhai, can you see the difference? Can you see the different slide, please?
Correct, sir. We can see that.
Okay, okay. Okay, now this is again one observation that a requirement of the Division 2 Schedule 3 to the Companies Act. Now, for the sake of brevity, I'll just say Schedule 3. Many of the time you'll see the additions to the immobile assets, non-current assets, but these need to be bifurcated into purchase or maybe any other cost, and more specifically and about the borrowing cost. At that point of time, you need to disclose two parts: A, the amount of the borrowing costs capitalized, and B, the capitalization rate or maybe the average capitalization rate, as the case may be. So this is one thing we should be very careful about. Many balances are not having this. About inventory recognized in profit and loss account, I'll demonstrate if possible, and I've written down the page numbers so that we don't waste time. Allow me a minute, I'll move to the L&T, and since we are on the Atul, we can go to word page number 125. So this disclosure, sir, is missing in many of the Ind-AS balance sheet. This last line item. If you can see the last line item, it says that amount recognized in standalone financial statements or the profit and loss account. So this line item I find is missing in the inventory. And when it comes to the L&T, let me take to page 383. If you are doing it, all very good, sir. No denying. Okay. If you're doing it, very good. But if you're not, please be careful about this statement. Now, during the year, 73.98 crore the previous were recognized as an expense toward the written down of the value. So this kind of disclosure as a must, and which were missing in many of the financial statements. Okay. Now the additional, you can I have seen many companies and they are feeling shy of adding additional line item, maybe in the notes to accounts, that is in the disclosure, or on the face of the financial statements. But if you don't want to clutter too much on the face of the financial statement, there is always an option to add certain additional line items in the various notes to accounts. For example, when it comes to the assets, you can say the owner assets, assets leased out. I have some assets which I own by me and self-use asset, but other category of assets, maybe I have leased out and in my capacity as a lessor. So even those you can disclosed as a separate line item. Then the assets measured at cost and assets measured at the revalued amount may also be can have a separate line item. So make the most of the additional the leeway given to you for the additional line item. Friends, this is one area which we have seen that certain you need an additional attention when it comes to the cash and cash equivalents. So in the first place, unpaid dividend do not form the part of cash and cash equivalent in principle, but still we've seen those are forming part of the cash and cash equivalent. So you need to be exercise a care concerning this. Then anything and everything which is maturing, anything which is maturing within 90 days from the date of reporting need not necessarily be classified as a cash and cash equivalent. As you can see, there's two examples. One deposit is of 1st April 2018, which is maturing on 15th April 21 for a financial year ending March 21. And again, the second deposit, which has been made on 1st of February 21. So out of these two, they quite rightfully, only the second category of deposit may only be classified as cash and cash equivalent. So what is important is not the 90 days time band limit from the end of the reporting period, but rather from the date of original maturity. That means that from the date of acquisition, the number of days of maturity should be less than 90 days. It should be here in this case from the date of 1st of February 2021 and not the balance sheet date. Second observation is that bank deposit with more than 12 months maturity under Ind AS shall be classified as the other financial assets maybe, but definitely they do not form part of the other bank balances. That option was given under the erstwhile non-Ind AS standards. There you still have an option to classify under other bank balances, but not anymore under the Ind AS. Well, again, this NSME on the face of the balance sheet have to be reflected and not as a part of your notes to accounts. So this you can see that I'm sure you must have seen, but still it dil hai ki manta nahi. Won't take much time. Computer G, be fast. Okay. Can you see here? Okay, trade payables due to micro enterprises and small enterprises and due to others. So this classification has to be made on the face of the balance sheet and not in the notes to accounts. So be careful about it, and I'm sure all of you must be doing that. Well, this is again a very important thing. Other comprehensive income is going to be covered by learned speaker Rajesh, but still I feel like saying something about this. So when it comes to the other comprehensive income, it's presented into the presentation is bifurcated into two parts. A, item that will not be subsequently reclassified to profit and loss account, an item that will be reclassified to profit and loss account. So as the name indicates, the second part is very clear and easy, that anything which has been accumulated in the equity through the other comprehensive income will be reclassified into bracket back to profit and loss account when certain conditions are fulfilled. For example, when the effectiveness of the cash flow hedge is not there, it will be transferred to profit and loss account. Or when the foreign operations are closed or wound up, at that point of time, the amount will be classified to profit and loss account. That's very clear. But what about the item which is not subsequently reclassified to profit and loss account? There, they have given a very specific guidance regarding the remeasurement of the defined benefit plans and fair value changes due to the own risk of the financial liabilities designated at FVTPL. The standard has division 2 has given a clear-cut guidance that these two items, remeasurement of the defined benefit plan, which is nothing but the actual gains and losses we normally sometimes call it, again net of taxes, and the secondary fair value changes in the credit risk of the financial liabilities designated at FVTPL have to be on the very same year, in the very same year, be part of the retained earnings. So on the one hand, you show them in the OCI, and then again you club this item with the retained earnings. In this case, Ind AS 19 has not given the cut and right guidance. So Ind AS has given quite rightfully very good suggestion that this will form part of the retained earning in the very same year. This is again liability, other borrowing cost. Well, other borrowing costs, yes, you've seen that, sir. We know that the borrowing costs, initial direct costs of the borrowing costs pertaining to the borrowing costs, initial direct costs pertaining to the borrowing costs are reduced from the carrying value, and they are included in the calculation of the effective interest rate method pursuant to Ind AS 109. But the costs which do not meet the definition of the transaction costs directly attributable to the issue of the financial liability and consequently not included in the part of the AIR. So we normally treat all these as the bank charges and everything, but the correct nomenclature for this is the other borrowing cost fees. So just be careful about this, friend, because we are used to use the word bank charges and miscellaneous charges, but they ideally should form part of your other borrowing cost. And sir, the following disclosures are not required anymore. I have prepared the slides for that, but I'm not going to dwell upon this because these are only for the theoretical importance, of course, to be read, because these are to be read. But I will quickly go about this. And Vishalji has asked me that, Yagnesh bhai, you please dwell upon certain items which are not required anymore under Division 2, Schedule 3 to the Companies Act, because in some balance sheet, it is observed that people still continue to disclose these items like about the disclosure. So, and the material and the credit for this material goes to the compilation done by the ICI for the guidance note on the Division 2 to the Schedule 3 to the Companies Act. So it's not my work. I have borrowed this part from the ICI material, and credit goes to the very well down crafted this material. So these are certain things like export of EBU, FOB, royalty, know-how, earnings in foreign exchange not required anymore, but we'll feel fine there. But then then the argument by them is that, so these are the additional requirement. Well, I understand this may be construed as an additional requirement from your perspective, but other may misperceive that you have not understood the disclosure requirement and you're still in a very wrong manner showing this, and you continue to show this. So these are certain items which are not is going to be not part of the new Division 3 requirements, sir. So allow me a minute, sir, and I'll move to Ind AS 8. Okay, Vishalji, Vishal bhai or
Yes,
Arpit
sir.
bhai? Vishal bhai, हाँ जी. Would you like to take the questions on Ind AS on the Division 2 Schedule 3 now,
Yeah.
or you want to take it later? It's
No,
open up to you.
there is one question. So since you have asked, I would share that, which says
Yeah.
that bank guarantee charges incurred for credit facilities to vendors.
Huh.
Whether
Bank
it will
guarantee
classify
charges.
bank guarantee charges incurred for credit facilities to vendors, whether it will classify as borrowing cost or bank charges.
Bank to the vendors, for the vendors, it is actually not strictly speaking you're borrowing, but it should be bank charges, sir. Hello.
Yeah.
In my opinion, it should be charged as the bank charges, sir. Still,
Okay. Okay.
yeah.
There's
Anything
one more
else?
question that has just popped up is, can there be classification in other bank balances as current and non-current?
No, sir. No, sir. No. You mean to say cash and bank balances, cash and cash equivalent on the top of the balance sheet? Then there are only two, cash and cash equivalent, and other balances. Within that, there is no current and non-current. So which kind of non-current you are envisaging? I think he's referring to the big deposits. Can you unmute the gentleman who's asked this question?
Yagnesh, he would not be able to unmute, but
Okay.
maybe so you can just elaborate about whatever are the options available for the benefit of members.
Okay. Now, if
So
you can see,
the question is with respect to the other bank balances.
correct. Fine.
Yeah.
So when it comes to the other bank balances, normally it cannot be classified again into one more category of current and non-current, because basically if you see cash and bank balances is forming part of the current balance only, current assets. Cash and bank balances, cash and cash equivalents on the face of the balance sheet is forming part of the current assets only. And now I'm just talking to this particular note about 12 so they can explain with clarity. Okay. All right, sir. Gentlemen, the one who asked the question, can you say this please on the screen? Or sir, can you see this? Both gentlemen, Arpit ji and Vishal ji?
Yes, sir.
Yes, we can.
Okay. Okay, now we see that current assets with banks, checks and drafts. So this will form your part of the cash and cash equivalents. Fixed deposit with the bank, maturity less than 3 months time. They have made it very explicitly clear that this is definitely a cash equivalent. Now, current assets, financial assets, other bank balances. The question is that should this be classified again in current and non-current? Is that the query? Am I right, sir, in understanding the question, Vishal bhai?
Yeah, so whether maybe you can also go to the schedule of non-current assets, whether there is anything like a other bank balance there. Yeah.
Okay. I'll go to that. So this is the current assets again. See, very honestly, the cash and cash equivalent, the note number 12 and note number 3 are the subset of the cash and cash equivalents, which is presented on the face of the balance sheet. Now, again, if you classify here as the current assets and other bank balances into non-current assets and show it under this category is wrong. So let's go to the non-current assets. So the standards say that any fixed deposit which is maturing, it will not be other non-current assets, it will be the other financial assets, non-current financial assets. Okay, fixed deposit with banks having maturity of more than 12 months time. Cash and can not available for the immediate. These are the restricted cash. And so if you are interested, then this part and this part is one thing which can be shown separately as a non-current asset, but as a but as a part of the separate note number and not as a part of the other bank balances, which is again forming a subset of cash and cash equivalent presented on the face of the balance sheet.
Right.
Vishalji,
Yeah, the next question, Yagnesh bhai, is again it is more for the classification where it has Rohit ji has asked that after this company's amendment we have to disclose the holding of cryptocurrency. Then where should the disclosure be made? Cash and cash equivalent or other financial assets in case of cryptocurrency?
Well, not from the perspective of the changes made in the Schedule 3 Division 2 of the Companies Act, but generally from the general knowledge and what is being followed worldwide is cryptocurrency is not cash and cash balance, it is the financial assets.
Right. Yagnesh bhai, there is one question that has been asked in continuation of this bank balance, current, non-current, that with respect to deposits, where original maturity was more than 12 months, but as at the balance sheet date, when I'm signing, or rather as at the balance sheet date, the remaining maturity is less than 12 months. So should the classification be on the original maturity or the maturity period remaining as at the balance or after the balance sheet?
Here the question is concerning the cash and cash equivalent or concerning the non-current and current balance.
So it is what I understand is the Aniruddha ji has asked is with respect to should I look at the remaining maturity period or the original maturity period for classification purposes?
Okay. Now, I presume that is not concerning cash and cash equivalent. Am I right? Can you ask the question to Aniruddha ji and then again come back to me, please?
It is not. It is basically with respect to where should we classify deposits.
Okay, sir. Okay. Now, see, when it comes to the current and non-current classification, the classification criteria are very cut and dried. That the classification is based on the balance remaining period from the date of the financial reporting. For example, you have taken so can you allow me a minute, sir? I will move to the, I will go to the one of the Excel sheet, and then so just a minute, sir. I know I can sharing, I'm sharing my screen, but anyway, sir, Excel is not sometime possible यहाँ पे. So can I explain verbally, please? Hello. Say
Yeah,
you've taken
please.
the first one fixed deposit, and you've taken, say, let's take the financial year 31st March 2021, and you have taken a deposit, fixed deposit, two fixed deposits, 1st April 2020, and one of them is maturing on 31st March 2023, and the second is maturing on 30th September 2021. On 1st April 2020, you have taken two fixed deposits, A maturing on 31st March 2025, and second is maturing on 30th September 2021. So as far as the number one is concerned, which is maturing on 31st March 2025, it should be classified as a non-current. As far as the second one is concerned, which is maturing within before 30th September 2021, which has the maturity holding period of maturity period of 18 months. Despite that original maturity period being more than 18 months, 12 months also, as on 31st March 2021, you will see whether this is receivable within a period of 1 year from the end of the reporting period or not. So fixed deposit number one will be classified as a non-current financial assets, and as far as the other one is concerned, that will be forming part of your other bank balances, which is maturing within 12 months from the end of the reporting period. So friends, the criteria is very simple and cut and dried. These are the same as given in the current assets and current liabilities. Like the way you, like the way, say, for example, why this two fixed deposits? Even one single instrument, where you are getting money at every year, one single instrument where you are getting money at each financial year ending, can be split into two parts. One is a current portion of the non-current assets, and second is a non-current portion of that. So as simple as that, sir.
One more question has popped up, Yagnesh bhai. Rajnath ji has asked that letter of credit given to supplier for 90 days,
Correct.
whether to be shown as a bank loan or trade payable.
Letter of credit. Have you availed of any financial facility? A good question though. Have you availed of any financial facilities, or it is just a letter of credit given to the other
It's
people? Right?
mentioned just the letter of credit.
So letter of credit is a non-funded liability. It should be classified as a contingent liability, sir.
And so the trade payable, so it would neither be a bank loan or trade payable, it would be a contingent liability in your view.
Yeah, because you're not paid anything, you're not availed of any facility as such. It's a non-funding facility. Have you incurred any liability on the balance sheet date, or it is a probable liability? Are you supposed to pay anything on the balance sheet date, or you may be required to pay at some point in time? Vishalji, can you clarify this from him? And this is my understanding that in case of a letter of credit, you're not paying anything on the date of the balance sheet, but it is a hanging sword. It's a contingent liability. You may or may not be required to pay. Yeah.
Yeah, I agree. I agree that only when the payment would have done or been made, that it would be in the forming part of the actual books of account. Otherwise, it would be as a contingent liability.
It is a contingent liability. It is a contingent.
Right. So, Yagnesh, you can continue. That's all that we have presently. And in the end, if there are any additional questions, we can take them.
Yeah, so ये पहला पड़ाव था, तो I thought कि let me take a break. I mean, before we embark on the second topic in this 8. So that's why I thought कि let us take the questions now. Okay, sir. Thank you, sir. Thank you. Okay, now this is a very, very important chapter, because this is dealing with the accounting policies, changes in the accounting, changes in accounting policies, changes in estimates, and changes and the rectification of error. The more so because of some typical requirement of Ind AS 8, there is no concept of prior period item or prior period error. We'll see that, and that's because of the paradigm change in the Ind AS 8 as compared to our existing accounting policy standards, that in case of a change in accounting policy or rectification of an error, technically stated in the standard as the restatement of an element of financial statement, which is nothing but the rectification of an error. This has to be applied retrospectively. So I have classified this is just a summary. I'm putting a summary at the outset so that in the hindsight of this table, you will be able to understand and comprehend this standard with more clarity. So broadly, this standard can be divided into three parts: A, change in accounting policies; B, estimates; and C, error. And I put some two color codifications. One is blue and one is green, because these are extreme and these are fixed and these are always without any exceptions. Rectification of an error, which is, as I mentioned, technically mentioned as a change, a restatement of an element of the financial statements, is always applied retrospectively unless impracticable to do so. That is an exception. Change in an estimate is always applied prospectively without any exception. So these are two extreme ends. Rectification of error is always retrospective, and change in an estimate is always applied prospectively. Fine. But when an entity changes, makes rectification of an error retrospectively, it has to give a third balance sheet if the changes pertains to beyond the comparative period. Say, for example, we now confine ourselves to financial year 2021. 2021 is the financial year, comparative is 1920. And if the rectification pertains to financial year 16, 17, 17, 18, in that case, you need to rectify this retrospectively, and there's a restatement of the comparatives, and in that case you need to give the third balance sheet. Now, which is the balance sheet? Into inverted comma. When an entity changes when an entity changes an accounting policy retrospectively or restate an element of the financial statements retrospectively, it will give one more balance sheet, and that balance sheet is at the beginning of the earliest comparative period. I repeat, balance sheet at the beginning of the earliest comparative period. Now let me put in the numbers. Financial year which we are talking about is 2021. Comparative is 1920. And the beginning of the earliest comparative, which is 1920, is the earliest comparative period, and beginning of that is 1st April 2019. जी हाँ दोस्तों, 1st April 2019 की बैलेंस शीट आप नए सिरे से बनाएंगे based on balance sheet of 31st March 2019 after incorporating the impact of rectification of error retrospectively and giving the impact of the change in accounting policy retrospectively. So 31st March 2019 balance sheet will be recast on 1st April 2019. So you will state it restated, and then 1920 financials would be restated just to make them comparable with the financial statements of 2021 from the perspective of change in accounting policy and rectification of an error, sir. So this is a very important thing. You need to give a third balance sheet, and a sequel to that, as a sequel to that, what do you mean by that? As a sequel to making the opening balance sheet on 1st April 2019, you will need to also make some changes in the statement of changes in equity. So what do you do by restating? What essentially you do by restating? Either any of the element of the assets is being impacted or a liability, and the resultant impact would be the retained earnings. So the impact could be either on asset or the liability on the one hand, and on the other hand, the retained earnings. You need to take into account the deferred tax assets. Don't forget that. So when you make these changes, you have to give a third balance sheet. Mind you well, not the third financial statements, only the opening balance sheet on April 2019 in our case. 1920 will be restated and 2021 will be a fresh return. So no need to rewrite that. So rectification of error applied prospectively and retrospectively. This is applied prospectively. One big paradigm change brought in by in AS 16 and AS 10 revised property plan equipment is that, friends, now a method of depreciation, I repeat, the method of depreciation is not considered as an accounting policy anymore, and it is now considered as an estimate. A very big change, as I mentioned earlier, the paradigm change brought in by Ind AS 16 and AS 10 property plan equipment revised. And there is one question after that, and a debate on this question a little later. All right, now let's come to the change in an accounting policy. In the first place, it's not open to the entity to keep on changing accounting policies as per its whims and fancies. An entity can change accounting policy when it is required by another index, or in a very rare cases when an entity considers that the change in accounting policy is going to make these financial statements more representative and more faithful. So only in those rare cases an entity can change accounting policy. We will see that how the changes in accounting policy are accounted for. Are they accounted for retrospectively, or are they accounted for prospectively? बताऊंगा 2 मिनट के ब्रेक के बाद. तब तक stay tuned, because it's very important that many companies have changed the accounting policy in recent past pursuant to Ind AS 115, contract revenue from contracts with customers, and Ind AS 116 releases. So these changes were required pursuant to an Ind AS and not voluntary. So we now need to see what is the accounting impact or the treatment for the change in accounting policy when it is required by another standard, A, and B, when it is changed voluntarily. We'll see in a short while from now. Okay. Then accounting policy is further guided by the materiality. So very important. We all of us know very well that except for an investment entity, all entities are supposed to consolidate the subsidiaries where they are exerting the control, where they're commanding the control. But I'll show you that even a companies like Bayer GmbH, which say that okay, it says that certain subsidiaries have not been consolidated. And interest in subsidiary in the joint ventures, and they don't have a material impact on the group, the financial statements, either individually or in aggregate, and are not consolidated but recognized as a financial investment in the equity in equity instruments. So this is the big change, and I have gone through this balance sheet, including the disclosure required for the German Code of Conduct, and I've seen that the company has not consolidated at least 97 to 98 subsidiaries and JVs, despite the fact that those are subsidiary, and despite the fact that Bayer GmbH is not an investment entity. The reason, it is guided by the concept of materiality. So an accounting policy that is immaterial effect may not be applied. Very important, sir. And this is where the Bayer has made a disclosure about these subsidiaries. But this is very important. But even the immaterial departure from the application of Ind AS is not permitted, nor immaterial mistake should be left uncorrected. So there's a difference between the item number 1 and item number 1 and 2, and item number last 3, 4. That if an item is immaterial, you may not apply the accounting policy at all. That's fine. But you cannot. But then second case, the case is covered by the bullet point number 3 and 4, is that you have started depreciating a property plant equipment, but then you forgot that to provide this depreciation on the property, plant, equipment, saying that it is immaterial. That is not permissible. So that's what they say, that even in the immaterial departure from application of Ind AS is not permissible. Um, then it's quite possible that there is no accounting standard applicable to your particular transaction or the event. So in that case, what you need to do is you need to develop, the management need to develop accounting policy based on the requirement uh, by the Ind AS in other standards, or go to the conceptual framework, and if still you don't find anything there, then you may go to the US GAAP for seeking guidance for this particular standard, which is not there in the Ind AS oblique IFRS. Now here they say that the entity can change an accounting policy if it is required by an Ind AS oblique 115 and 16, the recent example, or when the financial statement results in proving the reliable. Noida Toll Tax Company had made some changes. Of course, many companies have changed, but this is something very important, that they were applying the they were amortizing the intangible assets on the time basis, on SLM basis, but later on they have changed the basis of the depreciation from the SLM to the unit of production for the bridges and the roads and all this, depending on the how many number of vehicles they're applying on the road, and that's how they had changed the accounting policy. So this is the example of the change in accounting policy voluntarily. But we'll be more interested in how they are being accounted for, how they are being treated in the accounts financial statements. So here is the table which explain you. It can be changed in two cases: A, when it is required by another standard, and B, it is changed voluntarily. So now here is said in accordance with the transition provision contained in the required in the relevant standard. So 115, 116 had in the transition provision. In fact, 116 has given a lot of guidance in the regarding the transition provision for 116. So you have to apply according to that, either prospectively or retrospectively, or in case of the 116 abridged method. So in a nutshell, you need to be guided by the transitional provision in the relevant standard, which requires the change in accounting policy. But if there is no transition provision, it's unlikely though, but still, for sake of argument, if there is no transitional provision, or if the accounting policy is changed voluntarily, if there is no transition provision, or if the accounting policy is changed voluntarily, or I'll add the third element, the accounting policy is required to be changed pursuant to the transitional provision retrospectively. The transitional provisions say that you apply this retrospectively. So in that case, the changes shall be applied retrospectively. And if the changes are beyond the realm of the comparatives, then you need to give a third balance sheet. Which is at the earliest period, at the beginning of the earliest comparative period, which is at the beginning of the earliest comparative period. In our case, if the financial year ending is March 21, the comparative being 1920, the beginning of the earliest comparative would be 1st April 2019. You have to make one more balance sheet only on 1st April 2019 based on the balance sheet of 31st March 2019, and having applied the changes pursuant to the particular standard. Then 1920 comparative would be restated. Mention that these are being restated. Also mention in the notes to accounts in the disclosure that what are the implication of these changes. Okay. All right. Now I want to ask you a question. Arpit Bhai and Vishalji, can I throw this question onto the forum? Yes or no?
Yes.
Vishalji, can I throw this question to the forum?
Yes, yes.
Okay, now we've seen that when an entity changes an accounting policy retrospectively, voluntarily, when an entity changes accounting policy voluntarily, it has to apply it retrospectively. Yes or no? Everyone agrees with me? So you give your answer to RPG. Okay, fine. So a change in accounting policy applied voluntarily has to be accounted for retrospectively. Now, as a sequel to this, my question is, अगला प्रश्न आपके लिए, treatment of revaluation of property, plant and equipment and intangible assets pursuant to Ind AS 16 and 36. An entity was following the Ind-AS following the cost model for subsequent measurement. Mind you will have used the word subsequent measurement because initially they are always measured at cost. For the subsequent measurement of the property, plant, equipment, and intangible assets, the entity was following the cost model. Now it has decided to move. Now it has decided to move to revaluation model voluntarily on its own. My question is, should an entity apply these changes A, retrospectively, B, prospectively? Hello? हेलो अर्पित जी, क्या उत्तर मिल रहा है आपको? Which answer you are getting there? Hello, what answer you are getting?
Prospectively, retrospective. We're getting both types of answers.
What types of? Which are the majority? Tell you. Can you ask the person who is given the answer?
Prospectively is the majority. Majority is prospectively.
Yeah, विशाल जी बोल रहे हैं या अर्पित जी बोल रहे हैं?
Vishal.
Vishal ji, those who are, say that prospectively, can you tell them that the standard, when the standard says it in an explicit manner, that when an accounting policy is being changed by the entity voluntarily, it has to apply retrospectively. What makes them to say that it is to be applied prospectively? They could be right, no denying, but what is the basis of their answer, sir? Not just the logic, but there's a very specific answer in particular standard, and I'm going to share this with you. So, can anyone tell me the participant who has replied that it is to be applied prospectively? Can we give you the basis of your answer, please, or just the general knowledge or the logic? Hello.
Yeah, I'm getting a few comments, Yagnesh bhai. Because it is not considered as a change in accounting policy, that is one comment. Second is where there is change in estimate, it can be applied prospectively. Then where it is impossible to go retrospectively, then it is prospectively. Then it is revaluation, so how it can be prospectively. Basically, it is change in estimate and then has to be applied. So these are the broad responses we are getting.
Okay. No, okay. I agree with them partly, but not fully, because in the first place, the revaluation change in method is change in method. It is a change in accounting policy, very clear, sir. It is not an estimate. So let me rebut that answer that it is. I don't agree with them that it is an estimate, because if you read paragraph, those who are really, in fact, I appreciate that the people have endeavored to give the answer. I really salute them for their attempt. Salam दोस्तों कि आपने एक अटेम्प्ट किया, but basically still the change from cost to revaluation is still an accounting policy and not an estimate. Answer to this lies in paragraph number 17 and 18 of Ind-AS 8. So my dear friend, you can always have access to these two paragraphs, 17 and 18 of Ind-AS 8. And when you read these two paragraphs, you will find it is more or less on these lines. The initial application of change in accounting policy from the cost model to the revaluation is indeed a change in accounting policy. इस बात का इजहार करते हैं standards. They admit that it is indeed a change in accounting policy when we move from cost to the revaluation model. Agreed. But it goes one step further and says that when a change in accounting policy is made from cost to the revaluation, it is governed as a revaluation pursuant to Ind-AS 16 and 38 and not Ind-AS 8. This is a cut and dried specific exclusion exception given in the Ind-AS 8. And paragraph 18 says that paragraph 19 to 34 of Ind-AS 8, which are dealing with those things like how the change in accounting policy is to be accounted, how the rectification of error, and how the estimates are being accounted for, are covered in paragraph 19 to 34 of Ind AS 8. So paragraph 18 says in a very clear manner that Ind AS 8 will not be applicable to the items and visage in paragraph 17. So Vishalji, can you ask, has any of the research oriented participants have access to Ind AS 8 paragraph 17 and 18? Vishalji?
Yeah, they would be having it independently.
हाँ सर बोलिए.
Haji, paragraph 17 or 18 of Ind AS 8, if you read, it makes this revaluation as an exception, and hence it says very clearly they are not covered by Ind AS 8, but they are covered by Ind AS 16 and Ind AS 38. And if you read paragraph 40 and 41 of Ind AS 16, it says that the revaluation made at the date. So in that case, if you read in great detail in Ind AS 16, it says that revaluation is to be applied prospectively and not retrospectively. While I must appreciate all of you, those who have given the answer that it is to be applied prospectively, that you really applied the logic behind this statement. And my dear friend, logic is not beyond, the law is not beyond the logic. Accounting standard logic se par nahi hai. So you apply the logic correctly. Kudos to you, salute to you all well. But I wanted to give you more support in your argument, and that is coming from paragraph 17 and 18 of Ind AS 8. Okay, sir. So I hope, my dear friends, you got to read this. पढ़ा किसने कि नहीं पढ़ा सर?
Yes, yes, we are getting responses of yes.
Yes, no, fine. This is an exception to the general rule. Okay? This is an exception to the general rule. Like this, sir, if you are interested, I'll give one more paragraph. I'll not dwell upon that, but I'll give one paragraph, and that is again making. So, can you mute yourself, please? Can you mute yourself, please?
मिश्रा जी म्यूट करिएगा प्लीज.
So like this, this is there is more to it than meet your eyes as far as this slide is concerned. And what is that, sir? That if you read the standards in great detail, certain paragraphs in particular a particular standard makes the application of the other standards altogether redundant, even if on the face of it the case or the facts remain like same. I'll share one more example of this. Paragraph 68A. 68A of Ind AS 16. Please read this whenever you get time. And when you read this standard, there's written at the end of this, and at the end of this particular paragraph, it is written that under such circumstances, Ind AS 105 will not be applicable. Halaki, if you go to see and read this would fulfill the requirement of Ind AS 105, non-current assets held for sale and discontinued operations. So the point is, you need to really tag the standards when you read together. You need to connecting in there, just say, and see that are there requirements in other standard which will make this standard redundant. So 68A will make Ind AS 105 redundant. All right. So we understand that change in accounting policy is to be applied retrospectively, but we need to see in that case also that what are not construed as a change in accounting policy, बावजूद से कि they are changes in accounting policy. Looks ironical and paradoxical statement कि changes होने के बावजूद भी हम उसे change in accounting policy नहीं गिनते. What are these circumstances? So these are when applied to a transaction or an event or a condition that did not occur previously or that was immaterial previously, and that is substantially different from the previous occurring. So continuing with the Bayer example, that the Bayer has not been consolidating about 97 to 98 subsidiaries, JVs and associates because they were immaterial. But now this JVs, when they become material, the Bayer will naturally consolidate them. So that points that it was considered immaterial earlier, but now considered material. So this kind of a change in accounting policy, though they are change in accounting policy per se by the strict application of the standard, but they are still not regarded as a change in accounting policy from the perspective of the accounting treatment. Fine. So how retrospective is done by adjusting the opening balance of each affected component of equity, that is the retained earnings or any other reserve, and maybe the asset and liability as the case may be. So here I've given one example. So be very careful. The accounting year here is 1920 and not 2021. The preceding period, that is the immediate comparative period, is 1819. The beginning of the earliest comparative is 1st April 2018. So we are clear. Now, error notice in the current year. That means in the current financial year 1920, you noticed an error. And this pertains to financial year 1516, much beyond the comparative, much beyond the preceding period of 1890. The type of an error found is that an expense of 1000 was wrongly charged twice. Consequently, the creditors for expenses would have been credited twice. So, आपके creditors for expense भी ज़्यादा ही होंगे. All right. Now, let us see the impact of this analysis of expenses. What would have happened here? So what's the impact on the balance sheet of 31st March 2015-16? The retained earnings are understated because आपने एक ही expense को दोबारा debit किया है twice, गलती से, error. Current liability, creditors for expenses could have been overstated. So retained earnings have come down and the creditors for expenses have gone up. And on the income statement in the financial 15-16, the income was understated. Clear. Now, you got to know about this you notice in financial 1920. Now, you have to do the retrospective accounting under Ind AS. Let us see what we would have done under the erstwhile AS or oblique non-Ind AS. In financial year 1920, you realized this error. So the entry which you would have passed under non-Ind AS, under the that means the normal accounting standard, erstwhile non-Ind AS standard, debit creditors for expenses and credit the profit and loss account of current year only. Mind you, well, 1920. This will make the comparatives of 1819 incomparable. Okay. So financial 1920 income is overloaded as compared to the preceding years. Do you think it's comparable? No, it's not comparable. Notice the difference in the credit and debit. Notice the difference in the credit. The debit remain the same. Credit is in one case the profit and loss account, and in second case the retained earnings. And debit remains the same. Debit creditors for expenses, debit credits for expenses in both the cases. Now, what you're going to done? What are you going to do under Ind AS? On 1st April 2018, you will pass an entry. Here in this case, in our case, old standards, it was passed, the entry was passed in 1920 financial year. Whereas in this case, in financial year 18, 1st April 2018, entry is debit creditors for expenses and credit the retained earnings. Statement of changes in equity will be updated as of 1st April 2018. 1 लाख से बढ़ोतरी होगी रिटेन अर्निंग में. After this, there won't be any further entry in financial year 1920 because the rectification has already been cured on first. Rectification has already been made. The error has been cured on 1st April 2018. So. And now the balance sheet, the income of March 1920 and 1890 would be comparable because it's not it's not overloaded by the this entry of rectification of error pass. And friends, precisely for this reason, there is no concept of prior period error oblique prior period item under the IFRS because you are restating. Okay, if the error pertains to the year financial year 17-18, restate the retained earning on 1st April 18 and the relevant entry will like this. So this is what you do in case of the application of the retrospective when there is a rectification of an error. And you give 3 balance sheet, 2 profit and loss account, 2 statement of cash flows, and 2 statement of changes in equity. But the changes, the statement of changes in equity for the financial year 18-19 will have at the beginning that as at 1st April 2018 plus changes of the impact of the retrospective application on the error, and then restated balances on 1st April 2018. This is what I mentioned earlier, that here two statements of changes in equity, this will be altered oblique amended pursuant to this change. So this is how you do. And when you know that prospective application is nothing but the a prospective application is nothing but the is applied not retrospectively but prospectively. Okay, sir. This is very important. Ind is issued but not effective. The MCA has announced the certain new standards which are not applicable from the current financial year, where the early adoption is permissible, but entity has not adopted. So in this case, you will make this disclosure of the issued, in days issued, but not effective on the date of the balance sheet, and entity has not early adopted this. Very important, you need to mention this fact. And also the reasonable impact on the financial statements. You don't need to quantify those, but you need to at least mention that this may have a material or immaterial impact on the financial statements. केवल इतना ही लिखना है और कुछ नहीं. This is what you need to make this thing. And estimates, same like the erstwhile AS, they are always applied prospectively. Now, these changes in accounting estimate is fine. Why it is there? Why? What makes the changes in the estimates? As a result of any new information, more experience, or a new development, when you make changes in the amount estimated earlier. For example, I don't want to give one example, except that मैं केवल सब example दूंगा, क्योंकि जो example मैं नहीं देना चाहता हूँ उस पे छोटा सा सवाल अब आपके सामने आ रहा है कुछ चंद मिनटों में बाद. So other examples of change in estimates are the provision for doubtful debts, which is known as ECL model now, the changes in the behavior of the consumers for the redemption or for the estimates of the credit card ratings, credit card redemptions, then the provision for the warranty. These are all the estimates and which are to be applied prospectively. And there is one quiz here. Vishal ji, नमस्कार विशाल जी.
यस सर.
विशाल जी एक प्रश्न हो जाए सर.
बोलिए सर.
हाँ सर बोलिए.
जी हाँ दोस्तों, इसके रूट्स है पैराग्राफ 60, 61 and 50, 51 of Ind AS 16, but basically they are dealing with an estimate. Okay, now the paragraph 60, 61 of Ind AS 16 says like this, that at the end of each financial, at the end of each balance sheet date or the financial year ended, an entity will review the method of depreciation, useful life, and the residual value. I repeat, three items: methods of depreciation, useful life, and the residual value at each balance sheet date. And changes therein are considered as a change in an estimate and hence applied accordingly pursuant to Ind AS 8. Ind AS 8 requires that the change in an estimates are always applied prospectively. Yes, sir. So now my question is this. आपके सामने ये प्रश्न है दोस्तों, प्लीज रीड दिस एंड गिव मी योर आंसर. This is concerning the depreciation method followed by the parents and subsidiary. Parent is following, say for example, the WDV, and the subsidiary is following the SLM. Yes, in their separate oblique individual financial statements, they are allowed to follow the different method of depreciation. No denying about it. Yes, Sanatan सबके पहले भी था सच और आज भी सच है. अब प्रश्न ये है that for the limited purpose of consolidation by the parent of the financial statements of the subsidiary, which is following the different method of depreciation for depreciating its property, plant, equipment, should parent make any changes for consolidation, for the limited purpose of consolidation? A, yes. B, no. Arpit ji, please let me know what is the response of the very active and agile participants.
Yes, yes, yes. We need to calculate subsidiaries as WDV and consolidate.
That is
Adjustment
the
needs to
answer.
be taken in consolidated financial statements.
Okay, okay. Now, sir, सब लोगों ने अपनी राय दे दी, because now I want to bring your notice that हमारे जो participants है very active had mentioned at one point in time that XYZ is not an accounting policy but an estimate. So I want to draw statement and tell them in very clear manner that pursuant to the paragraph 60 and 61 and 50 and 51 of Ind AS 16, A, method of depreciation, B, useful life, and C, residual value of the property, plant, equipment are considered as an estimate and not an accounting policy anymore. जी हाँ दोस्तों, भाइयों बहनों भाइयों, ये change is a big change, is a paradigm change brought in by Ind AS 16, and not only Ind AS 16 but even in AS 10 also. AS 10, maybe if I'm not mistaken, it is paragraph 53 and 63, that these three are not considered as an accounting policy. In fact, rather, to be more specific, method of depreciation is now considered as an estimate, and chunki estimate hai, isliye it is being applied prospectively. But to coming to this answer, the answer is that the parent need not restate the depreciation amount of the subsidiary even for the limited purpose of consolidation. The reason being, it is not an accounting policy anymore, but an estimate. विशाल जी,
Yes, Yagnesh bhai.
ये है मेरा उत्तर, and I want to seek your opinion also, Vishal ji. What is your take on this? And anyone is free to move to read paragraph 60 and 61 of Ind AS 16, which says very clearly that it is an estimate. And I don't remember exactly the answer in the ITFG, but allow me a day's time and I'll come back to Vishalji with the answer in ITFG about this matter. Ind AS Transition Facilitation Group has covered this query and they have given answer affirmative that there is no need to make any changes like this. Vishalji, I'll text you this answer maybe by end of the day today.
Sure.
This is covered in the ITFG bulletins. Well, I must say that Vishalji, you say that you keep last 15 minutes or so for the question answer, but we have covered half portion earlier, so I'm leaving exactly about 8 minutes for question and answer. But before that, let me tell you something. Friends, I'm a chartered accountant and a CPA both. But the kind of literature our Institute of CA is giving, which is almost free of charge. You take the ITFG bulletin, you take the educational materials for Ind AS. Forget about the guidance note, battery of guidance notes the Institute has given. These are all coming free of charge. But since they are coming free of charge, we don't evaluate them. The same material, if you need to subscribe on AICPA platform, you need to shell out hefty money even for the bare accounting standards. And I'm repeating, for the bare accounting standards, even if you remember, one is to give $50, $100 and so much. Whereas what our institute is doing, this webinar and all this, if you look at the price, is nothing, sir. The kind of material you get from the institute, the kind of material you get, the education material, ITF, bulletin, and so many plethora of documents you get from the ICI, they are valueless. They are invaluable. My friends, make the most of use of the ICI materials which are coming free of charge. Free of charge है इसका मतलब ये नहीं कि इसकी fair value कम है. Okay, friends. So this is my one hidayat, and salute to my ICI. God bless you. Vishalji, we can take the questions now.
Yeah, so we have one question that if the company, Indian company has foreign subsidiaries where Ind AS 116 is not applicable, then for the purpose of consolidation, do you need to calculate the rent paid by foreign subsidiaries in accordance with Ind AS 116, or consider it as a rent expense only?
No, I got your point, sir. So Indian company is following the Ind AS. It has a subsidiary in a foreign country, and that foreign country is not following the naturally the IFRS. Okay, that's what the question is about. And for the purpose of consolidation, of course, while the subsidiary which is based out of India is free to follow the local accounting standard, but when it comes to the consolidation by the Indian company which follows the Ind AS 116, it has to, for a limited purpose of consolidation, restate the financial statements of the foreign subsidiary to match with the accounting policy of the parent, Indian based parent, and then do the consolidation. Friends, एक जमाना था जब UK, USA, UK and the European countries, European Union countries had applied the IFRS, and the Indian subsidiary of those companies were not following the IFRS. So at that point of time, they had to restate the Indian entities' financial statements to match with the IFRS of the EU countries for a limited purpose of the consolidation. So the answer is yes, company has to restate as per Ind AS 116.
Right. Yagnesh, there are no further questions. So maybe with your permission, can we, in fact, just let me see, there's something that has. I think this is a question which you already answered. Yeah. If parent company follows WDV and subsidiary follows SLM, I think your response would be similar, that accounting policy estimates.
Yeah, same. And sir, in support of this, Vishalji, I will share with you the relevant question in the ITFG and
Sure.
or maybe the educational material. Yeah.
Are there any exemptions for consolidation?
There are exemptions for the consolidations given if the parent is an investment entity. If a parent is an investment entity and it accounts for the investment in the subsidiary at fair value through profit and loss account, it need not consolidate the subsidiary A. I repeat once again, if the parent is an investment entity as defined under standard Ind AS 110, then, and if it accounts for the investment in subsidiary at fair value through profit and loss account, it need not consolidate. B, there are some exemption given for the non-public entity. If there are chain of parent and subsidiaries and all these, and the ultimate parent consolidate all these subsidiaries, then the non-public entity, that means the interim subsidiaries which are not public entity, meaning their debts or equities are not listed on the stock exchange, or they are neither in process of getting listed on the stock exchange, then those interim subsidiaries are not required to consolidate their accounts. And this is given perhaps in paragraph number 10, if I'm not mistaken. And this is built in the Companies Act from July 2017 notification.
Right. Yeah, I think that's all, Yagnesh bhai. So with your permission, I would like to.
आपके हवाले है सर, आपके हवाले है सर, हम तो जो आप चाहेंगे हम स्वीकार करेंगे इसे.
Yeah. So, Yagnesh bhai, thanks for responding to all the queries to the satisfaction of the members. And members have requested if they could have a copy of the presentation, which we can upload on the WRC website, which the members can use for the future reference.
Sir, by
So,
all means, sir, आपके लिए आपकी खिदमत में बना है सर ये. We'll share it for you, sir.
right. Thank you, sir. Thank you so much. I would
My
now request for Archit to kindly propose a formal vote of thanks.
Thank you, sir. On behalf of WRC of ICI, I thank you, sir, for sharing your views on the topics covered. It was really very nicely explained with the practical examples. And we hope that every participant must have gained the better understanding through this session. Thanks a lot, sir.
Thank you, Yagnesh bhai.
Okay, sir. Bye.
Bye,
Everybody
bye.
have a
Thank
happy
you.
Holi and God bless you. Take care. Stay safe.
Bye, sir.
I now log out, sir. Bow out for you. Thank you.
Fine. Okay, sir. Okay. Thank you, sir.
Okay, sure. Bye.
I would request Rajesh bhai Mody, if you could switch on your camera, please. Yeah. Good morning, Rajesh bhai. Welcome. Rajesh bhai, you'll have to unmute yourself, sir.
Yeah. Good morning, Vishal bhai.
Good morning.
Morning, sir.
Friends, we move on to the last leg of this day and this course. And originally we had CA Mayur bhai Choksi, but for unavoidable circumstances and reasons, he is not able to be with us today. And I would specially thank Rajesh bhai, who accepted at the last minute, just a couple of days back, my request to make the presentation on the Ind AS 1, 8 and 10. So thank you, Rajesh bhai, on my personal behalf and on behalf of WRC. Friends, Rajesh bhai was there on the second day of our course on the compound financial instruments. And in fact, there was one question, Rajesh bhai, today that was asked, which I have kept in abeyance for you. But we'll take it up in the end. It was with respect to deferred tax on contracts. But I would now request Archit to kindly give a short introduction of Rajesh bhai, please.
Correct, sir. Thank you. CA Rajesh Mody is a practicing chartered accountant. He is presently associated with CNK and Associates LLP as a director for statutory audit. He has more than 25 years of experience, and his area of experience includes Ind AS, auditing standard, and accounting standards. He is a regular speaker at study circle and study group for Ind AS. He is highly rated faculty for IFRS certificate course by ICI. He is empaneled as a technical reviewer with FRRB of ICI. He has addressed members and students for accounting and auditing standards at a large forum. With this short introduction, I request her to take charge.
Yeah. Thank you, Arpit, for the kind introduction. And thanks, Vishal bhai, again for giving me this opportunity. It is always my pleasure to be part of the initiative of WRC. And always you can bank upon me wherever it is possible. I will try my best to be available to you. Thank you again. Friends, this is our second interaction. On 14th, we had one session on Ind AS 32, which I had taken. And today, actually, we will be dealing with actually presentation and general principles which covers the presentation of financial statements. So your question will be, why these standards we are taking at the fag end of the course and not at the beginning? If you have noticed, friends, in the index you will find always two standards which starts as number one, that is Ind AS 1, which is presentation of financial statement, and 101, that is actually first time adoption. So question arises, if those are the beginning numbers in the standard index, then why we are dealing with them mostly at the end, fag end of the course? Friends, because unless, because if you go through these two standards 101 as well as Ind AS 1, you will always notice that it is gives general guidelines and principles that how you will deal with the presentation or a policy choice, accounting policy choices, when you are either first time doing the first time adoption, first time transition, or maybe you are preparing the Ind AS financial statements. So it is a general guidelines which is provided by these two standards. So unless and until you have a basic understanding of rest of the standards, you will not be able to come and present your financial statements, or maybe you can choose your proper accounting policies unless you have the knowledge of other standards. So even though it starts with Ind AS 1 as a presentation standard, but rightfully the organizers have selected to keep it at the end. And even when we do the courses on Ind AS or IFRS, our institute also has this type of schedule where always 101 is the last standard which they take. So that's how, that is the logic behind this, and rightfully I congratulate the organizers for keeping such thing in mind, because these are all minute things, friends, but it has a very impact on the overall understanding of the presentation of the standard. So that is how we should be dealing with, friends. So hopefully over across a period of last six sessions or something, you must now have understood the nuances of important standards and how it affects your actually presentation, recognition, measurement, as well as disclosure. Today actually our basic coverage will be more focus will be on the presentation part and somewhat disclosure parts. And in the first session today, you must have actually understood how under India we have schedule 3, which actually mandates the format and how it has to be dealt with, and which items will become your where you have to present it. So this is what kind of disclosures you have to make. This is all is covered by that schedule 3, which comes under the Companies Act, and that's why it becomes mandatory. However, under Ind AS regime, always you will find that there is a flexibility available even in the standards as well as in the schedule 3, that it will say this is our minimum requirements which we suggest, but other things, if it is beneficial for the understanding of the members, you can always welcome to provide more disclosures, the better way of presentation within the framework of the overall Ind AS as well as schedule 3. So always keep this in mind, friends. There is no hard and fast boundaries, but within the overall structure, you are free to uh, give more information which will be actually beneficial to the users. That is actually the crux of Ind AS or IFRS. Now, before we actually start with actual presentation on Ind AS 1, we would like to cover that why you will find under Ind AS or IFRS regime, there are so many extensive disclosure requirements. Why it was not previously there? So first thing, friends, previously we were used to more of a kind of rule-based standards, but under Ind AS and IFRS, you will find that we have moved from rule-based to principle-based. So here, most important deciding factor is that what is the substance of the actually transactions or nature or the contract which the business is dealing into. So legal form you have to ignore. Mostly the presentation or recognition, measurement, everything will be ruled by substance over form. So always keep this in mind, and accordingly your presentation can vary, because that is not based on the legal form. In Ind AS 32, when we were dealing, I think we have covered how we classify between equity and the financial liability. So best example was that preference shares. Maybe under the Companies Act, for the definition purpose, it may be part of the share capital, right? But when it comes to Ind AS, it is very clear that if it is redeemable, then from day one it becomes my liability, and it will be taken to borrowings and not as a part of equity or share capital, right? So here terms are important. So that is how Ind AS differs, friend, and that's why the first point, as I said, substance over form is the guiding factor. or I would say it's the crucial fundamental difference, right? Other things are actually fair value or time value of money, which is given more importance under IFRS and Ind AS regime. Previously, it was not there. So that also plays a crucial role, because wherever fair valuation comes, always there will be a chance of judgment, estimation. So, and once you do that judgment or estimate, user actually should know.
मोदी सर पीपीटी शेयर करिए ना सर मोदी सर
हाँ
आपने
नहीं, अभी
screen
तक चालू ही नहीं किया है. I have not yet started PPT. ओके ठीक है, मैं एक पीपीटी रख देता हूँ स्क्रीन पे. ठीक है, अभी तक मैं गया ही नहीं हूँ पीपीटी में सर, दैट्स व्हाई.
ओके सर
वन सेक. Yeah, hopefully now that PPT is visible, right? Okay, fine. So friends, that's why, because here the standards are principle based, the standard gives freedom to the entities or the management to structure their accounting policies so that it reflects the actual substance or the transactions when they are dealing. So actually it should reflect the true transactions, how they are commercially treated. Best example I can give, friends, of Ind AS 103 business combinations. There actually previously what we were doing, either AS 14 was applicable. So under that it was just rule based that if it is either you can go by pooling of interest or purchase method, and this is how we will do, this is how we will calculate a goodwill. Simple, right? Many things were not permitted for you, even though you may have paid a substantial amount to capture those items, but standard was not giving that freedom. However, under Ind AS 103, actually it goes by that how the transactions has been done across the table between the two entrepreneurs, and exactly how much amount they have paid for any particular type of item. That is how in consolidation under 103 it will allow you to capture those items and reflect at the true worth or value at which this has been transacted. So this freedom is given under Ind AS regime, friends, which was not available previously. So what we were used to do, even though I have paid a huge amount for a particular item, that was taken as a balancing figure in goodwill. So now, because of this substance over form getting precedence, you are able to reflect the actual amounts for which you have paid for any item. So that is the main difference. So here, friends, as a user, how the users will know that what thinking process has gone in the minds of the management to arrive at a particular type of accounting policy, unless that disclosure of judgments that management has taken, or they have gone through that process of arriving at that judgment, right? So that process which is in the minds of the entrepreneur, now it has to come out as a part of disclosure in the standards. And that is the basic difference. You will find that now that volume of material as a part of your annual report relating to the financial statements maybe have multiplied 2 or 3 times compared to the IGAP regime. So this is the basic difference, that whatever the thinking process has to come out on the table, and as a part of disclosure you have to provide this, right? So another example I can give is under Ind AS 110, before you come to a conclusion that whether I should consolidate a particular entity or not, you have to first identify the control aspect as per the definition given under 110. So there again, friends, it is possible that even though I may not be having a voting rights of more than 50% as a thumb rule to consolidate entity, but because of other shareholder agreement or other covenants, I may be having the control over the board, or I may be having the control in the decision making of the company or entity. So because of that, even though I may not have that holding, I can have a control over the entity under 110, so that I will be actually consolidating that entity and not the other party who may be having more than 60%. So maybe he may not consolidate because of the control definition which is under Ind AS, he may not have that power to control that entity. So even though holding 60%, he may not consolidate. This is possible under Ind AS 110. So how you have arrived at that? You are actually, even though you don't have that voting rights, you still control that entity. So that judgment or the factors which you have considered has to be disclosed. Unless you do that, how that other users of the statement will know this? So these are the things, friends, which will determine what you will disclose in your financial statements. So that's why I'm saying Ind AS 1 is a general principle based standard, friends. It is just guides you that what things you should keep in mind, but ultimately all those aspects of how you determine that accounting policy, what disclosures you make, actually are governed by the relevant Ind AS which are applicable to that particular items in the financial statements. So those things will come from the that relevant standards. So you will not find that only presentation for that one किया तो आपको presentation सब आ गया. No, friends, it is just a general principle which will guide you that what things you should keep in mind. But actually presentation, recognition, disclosure, measurement, everything is dealt with by the each individual standards which applies to your item of financial statements. Okay, so that comes from there. So unless you understand those standards, you will not be able to comply with Ind AS 1. So that is how I thought before we start, you should have that overall understanding, what is the background behind this. And that's why again I said this is the best thing. We learn this at the end, because that is how we will be able to just give justice to this requirement of the standard. Okay, so again as a matter of fact, I will always request that you should go through schedule 3, you should go through guidance note on schedule 3 division 2, maybe division 3 if it is NBFC, plus FRRB publication on common mistakes which is found during the review with the FRRB carries on of the listed entities. So there I think, friends, you will find small things where people or the entities miss out, and they make the mistakes, commit mistakes while preparing the financial statements. So that is the learning process, friends. So if you go through this guidance which is available with the institute, I think it will help a lot in taking the right kind of decisions and right presentations. So this is what I think I thought before we start, we should actually know this. So now actually we can start with the proper presentation, friends. So let me first begin with Ind AS 1. So this is our topic agenda, friends, Ind AS 1 and Ind AS 10, because I think Yagnesh Bhai has touched upon Ind AS 8, but however we will take one or two examples of Ind AS 8, how that changes in accounting policy the companies are implementing, what disclosures they are doing. So I think there it will be covered. Fine. So otherwise my basic coverage will be basically on these two standards, and in Ind AS 8 we will do some presentation how they are doing. So that we will be covering, friends. So this is my first standard, friends, presentation of financial statements. Now brief overview, friends. So first we will be dealing is that what are the objective and scope. Then we will be touching upon key principles, because these are very relevant in deciding where to present what things. Then we will deal with individual financial statements items, what makes it a financial statement, complete set of financial statement, and what are the minimum disclosures which Ind AS 1 actually prescribes that one has to follow. And then maybe few major differences between IFRS standard, that is IAS 1, and Ind AS vis-a-vis Ind AS and our IGAAP standard. So this is how we will be dealing when we will be taking a few examples, and at the end we will be going through one or two listed entity financials where you will find how these requirements of Ind AS 1 actually are being dealt with. So this is how we will be doing, friends. Now always before we start, we should understand what is the objective and scope, friends. So as I said, this is the standard prescribes the basis for presentation of general purpose financial. What is general purpose, friends? Actually, when we say it is a specific purpose, then you have some contractual arrangement with the entity where you have access to information, and you can ask to entity to present you such information the way you need. Like we can say certain information which credit rating agencies may have, right? Even the banks sometimes have a power to ask for certain information, but otherwise general purpose means where that user does not have the right over the entity to ask for any specific information, but they depend on the general information which is available in the public domain. So that is why in such financial statement we call it as a general purpose financial statement. So uh, how to make it more user friendly, friends? So that is the main purpose behind this Ind AS 1, because you should understand that that person has a limited access to the information which the entity may hold. So whatever information in public domain is having, it should be structured in such a manner that it becomes useful, so that he can take a right economic decision based on that information which is provided. So it should be relevant, friends. It should be useful, friends. It should be unbiased. These are all actually conventions which you know, and it should. So we will go through those things, but keep in mind this standard deals with general purpose financial statements. Okay. And what is the main objective? So that it ensures comparability between the entity's financial statement of previous period and with the financial statement of other entities. So that is the main purpose, so that the user can take a proper call and do the analysis, right? And based on that analysis, he can predict that what is the future flow of the entity's growth, or how the entity is moving towards in the future, right? So that is the main purpose. Scope: an entity shall apply this standard in preparing and presenting general purpose financial statements, friends. Does not apply to structure and content of condensed interim financial statement as per Ind AS 34. So there actually because it is for the limited purpose of like limited review kind of thing. So there is a only few paras of this standard is applicable, not the full standard. So that is what is excluded, friends. Now, what is the features of financial statement? So what principles it should keep in mind while presenting? So foremost principle is, friends, that true and fair view presentation. So whatever you are presenting, it should be true and fair view, right? So if it is, unless it is true and fair, you can't say that this my financial statement is in compliance with Ind AS. So that is very, very crucial. Another important thing is it is based on the presumption that it is on the going concern basis, but it is a fundamental assumption, friends, that financial statements are prepared on going concern basis. If it is not on going concern, then there are separate detailed disclosure requirements, and the measurement things itself changes, right? So that also we will be covering when we deal with the Ind AS 10. So how to deal when the entity is not a going concern, or maybe there is a material uncertainty on the going concern assumption. So how this is to be dealt with? But prima facie, the fundamental thing is that it is on going concern basis. Accrual accounting, another important assumption, friends, that it is based on accrual basis of accounting. If it is case basis, then it is not in compliance with Ind AS, so standards will not apply to that. So keep in mind, it is accrual basis of accounting which is fundamental. Again, most important, friends, materiality aggregation. So here in July 2020, there was amendment which was carried out on by 24th July 2020 amendment, where they have now in detail discuss what is materiality, friends. So that also we have to keep in mind that anyhow, if you are deliberately doing something so that the user gets confused or user is misled, then that is covered under that materiality definition which they have said. Then that financial statement will not be treated as a true and fair presentation, friends, and it will not be in line with Ind AS requirements. So that is very, very important. Offsetting, again, friends, Again, if you are doing wrong offsetting, then again you will be misleading the person who is actually the users. So there are strict rules when you can do offsetting, and again, as I said, it is covered by the specific standards, right? Like in Ind 32, there they define financial asset and financial liability when it can be offset. uh, so same way, if you sell something like you're not on as a part of your revenue recognition, but as a investment you sell, or you sell your PPE, then you will only present the gain and you will not show as a part of revenue, right, friends? So these are all things when you will do it. Then consistency, from one period to another period, whatever you are following, you consistently follow that, and only you can change the accounting policy when it is permitted or required by the standard, or it helps in proper presentation. Otherwise, you have to maintain that consistency, friends. So if all these principles actually are mandatory, friends, because any of this is missing, then your true and fair is a question mark. So that's why keep in mind, frequency of reporting, the standard is saying that at least annually this has to be done, right? And comparative information, again important, unless you give that comparative information, that user will not be able to judge that what is the performance of the entity, what is the position of the entity, and how the cash flows are moving, and how the direction of the entity is going forward. So unless you do that comparison, nobody will be able to judge based on the only 1 year presentation, right? So all these things will ultimately lead to true and fair presentation. So always keep in mind, friends, these are the guiding principles which always should be in your back of the mind when you deal with presentation. So as we have said, friends, true and fair view, so ultimately it boils down on accounting policies which you select, right? So at the time of selection of accounting policies, you have to follow Ind AS 8, and there again the guiding principles that substance over form, and actually it should present how the standard or the structure of that contract or the transaction has been carried out by the entity. So it should reflect that. So that is how that policy should be chosen, right? And wrong accounting policy will not, if you disclose that this is my policy, then it will not rectify what is wrong, friends, right? So by just disclosure alone, you can't rectify what is wrong. So what is wrong is wrong. So you have to go by the guidance available in Ind AS 8, what you have to take care while forming an accounting policy, right? And this is, I think, if management concludes compliance with an Ind AS is misleading and conflicts with objective, departs from that, if it conflicts with the objective, what are the objectives, friends, which we have actually seen, right? These features we have to always keep in mind. So if true and fair presentation is deviated because of maybe some of the standard which we as per accounting standard, it says that you have to follow this way, and if by following that your management feels that what is my actually substance is not able to come out properly and it may mislead the users, then in that limited circumstances, standards permit you to depart. But it requires a comprehensive disclosure, friends, that why management feels that by following that particular standard, true and fair presentation will be deviated. So that is to be required only of relevant regulatory framework requires or does not prohibit, and it is extremely rare, because generally if it is you are in compliance with Ind AS, then generally it should help you in true and fair presentation, right, friends? So these are very few type of transactions where you may come across. So that's why they are saying it is extremely rare cases, right? Now this is very important, friends, compliance with Ind AS. So you have to give an explicit and unreserved statement of compliance with Ind AS to be included as a part of the notes. So always you will find, you can take up any entity's financial statement which is prepared under Ind AS, you will find this statement that it is in line with Ind AS requirements. So unless you give this, even though you must have fulfilled all the conditions of all the standards, still if you don't give this statement, it means that you are not in line with the requirements of Ind AS 1. So that's Ind AS is not as per Ind AS standards. So that's why, friends, keep in mind this statement has to come, and you will find in all the balance sheets, you will find this statement which is given, right? Another most important, friends, going concern. An entity is a going concern unless it ceases business trading, means it ceases to operate, intends to liquidate, or there are no realistic alternative, like we will go through it when we go to Ind AS 10, friends, event which occurs after the balance sheet date. So something which has catastrophically affected the entity, like maybe under COVID-19 situation, you may have found that certain industries which has been highly impacted, and because of that many small entities in those industry had to shut their shop, right? So then those becomes non-going concern basis. So there it is like no realistic alternative but to do so. It falls under that thing. So management cannot say that it is a going concern, and then accordingly everything will change. Your presentation itself will change, and the disclosure will be required, right? Management shall make an assessment of an entity's ability to continue as a going concern. When financials are not prepared on a going concern basis, the financials should disclose that fact together with the reason why the entity is not considered as a going concern. So here actually, friends, it is both way. So one is that if it is not a going concern, then management has to give reasons that based on that principles enlisted above, that whether they have ceased to do operate, whether it intends to liquidate, or what has happened because of that they feel that the entity will not be a going concern. So those things the management has to disclose if the financial statements are not prepared on going concern basis. However, suppose there were uncertainties, right? And prima facie one can feel that based on this uncertainty, chances are that it is not a going concern, but still management has prepared the financial statements based on the assumption that it is a going concern, even though there may be huge material uncertainties which is prevailing and which is affecting the entity. Still the management feels that no, they will be able to continue as a going concern. Then in that case also, Ind AS 1 clearly mentions that management will have to disclose that why, even though so much uncertainty is there, still they feel that the financial statements is prepared on a going concern basis. So both way, standard is very clear, friends, that reasons has to be disclosed. So as I said, accrual basis, yes, that is fundamental assumption. Now materiality aggregation, friends. So it again guides that you have to present separately each of material class of similar items, right? So if it is material and it is similar, that club together and present separately, and items of dissimilar nature has to be separately, because you can't merge a dissimilar item with the similar item, right? Unless they are immaterial, right? So otherwise standard says if it is not a it is a dissimilar item, then you can't merge with similar item, but you have to disclose it separately if it is a material thing. However, if it is immaterial but law requires that those item has to specifically be disclosed separately, like MSME trade creditors. So even though it may be immaterial compared to the whole trade payables, but still because standard says that it has to be disclosed separately, we are doing it. So there that materiality concept will not come, friends, wherever there is required by law. Otherwise you have to keep in mind similar items you can club it together, and if it is material has to be separately disclosed. These similar items you cannot merge with similar items, and if it is material then you have to disclose separately, friend. Okay. And as far as the materiality is concerned, friends, so as I said, there was an amendment. So what they are saying is information which is material, if omitting, misstating or obscuring, it could reasonably be expected to influence decisions that the primary users of general purpose financial statements make on the basis of this financial statement. So deliberately you are trying something so that the user will take a wrong decision, right? So then they are saying that these things will not be permitted. Okay, so materiality is to be in the context of its financial statement taken as a whole. So you have to consider the whole statement for determining what is material from the angle of the user, friends. Information is obscured means akin to omitting or misstating the information. So you are deliberately trying to mislead. So that's why they are using the word information is obscured, right? And information which they are giving, I am actually reading from the actual amendment which they have done, the gist of it amendment. Information is disclosed, but language is vague or unclear. So we have that in Mahabharata, that Yudhishthir used that word Narova Kunjrova, right? So it is akin to that. You are saying that okay, in compliance part I am giving the information, but deliberately you are using vague language, incomplete sentences. Dotted, even though you said yes, prima facie you are compliant, that you have disclosed, right? But deliberately you are giving half information. So that the standard says you are actually obscuring, correct? So this thing you have to avoid, otherwise it will not be in line with the requirements. These similar items, transactions or other events are inappropriately aggregated. As I said, these similar को similar के साथ आपने mix कर दिया. So deliberately you are trying to confuse the user. So that also will not be permitted. Similar items, transactions or other events are inappropriately disaggregated. And I said, if similar items you can club it together and you have to show it as a one item together if it is material, right? But here material items, similar items, you are actually not taking it together but showing it separately, so that you may come under that it is not material. So if those kind of things are adopted, then maybe you are not in line with the requirements of Ind AS 1. Or material information is hidden by immaterial information to the extent that a primary user is unable to determine what information is material. So दोनों ऐसे mix कर दिया आपने, और immaterial information के अंदर you have merged it, so that user will not be able to identify out of this whole detailed list of that items which is material for him, right? So आपने सब mix कर दिया जानबूझ के. So again this will not be permitted. And so this is what the amendment they have brought, so that by this amendment actually they are trying to clear out with examples that what they mean by materiality and aggregation. So please keep in mind, friends, from effective July 2020, if any such kind of things or this kind of tricks are being used by the management, then as an auditor or even as a part of accounts team, I would suggest that you should draw this attention of the management and bring it to their notice that after this amendment, specifically if such kind of things are there, then it will be a qualification which the auditor will have to give, and it will not be in line with Ind AS. So has to be kept in mind, friends, right? So that's why I am giving more stress on this particular item. Be careful. So again, offsetting, as I said, it is actually dealt with by the individual standards, what is permitted, what is not permitted to be offset, and not by Ind AS 1. Okay, frequency of reporting, as I said, at least annually, and when there is a change in the end of reporting period and presents for a period longer or shorter than 1 year, then an entity should disclose reason for longer or shorter period. Like sometimes what happens that some consolidation acquisition happens, and because of that other entity may have to realign that period to fall in line with the parent entity. So maybe because of that you can find that there will be a change in the period of reporting. So that has to be actually, reason has to be disclosed. And the fact that the amounts presented in financial statements are not comparable has to be disclosed, because that two periods are not same. Previous year may be more or less than 12 months, and the current period also can be different. So that's why these two things one needs to disclose, friends, compulsorily. Now comparative, most important, friends. Numerical comparison in respect of previous period should be disclosed. Okay. Narrative and descriptive comparison information is also required to understand the current period's financial statement, and additional comparative information may also be provided voluntarily, say third statement of profit and loss. Okay. And if impractical to reclassify comparable amounts, disclose reason for not classifying and the nature of adjustment that would have been made if reclassified. So under at Index 8, you must have seen that whenever there is a prior period errors, or you are reclassifying the comparative periods, or maybe prior to that period, then retrospectively it has to be done, correct, friends? So many times it is impracticable. Then in that case, Index 8 permits certain things that okay, if it is impracticable, then no problem, prospectively you can do this. So whenever such things are there, then it has to be properly disclosed. So this is very, very important, friends. Now financial statements are a structured, as I said, pure saal mein there will be lakhs and lakhs of transactions with the entity deals with, and then it is segregated based on that similarities like assets, liabilities, income, expenses, correct, friends? So it is a structured representation of the financial position, financial performance, and cash flow of an entity, which they present at the particular reporting period end, so that user can know what actually has happened in the entity. So that elements of financial statement, when we say, those are actually assets, liabilities, equity, income, expenses, contributions and distributions to owners in their capacity as owners, and cash flows. So if this all included, we can say it is elements of my financial statements. And all these definitions, friends, comes from actually framework. So always I would suggest that before you start your journey into Index, go through that framework. It will help you like anything. Okay, because from there you will know exactly what is my asset, liabilities, and based on that, then you will decide which index you should refer, right? So if you see your index, the whole literature of index can be segregated or compartmentalized based on certain traits. Okay, certain standards are asset based standard, so all those you can deal with it together. Like we have index 16, we have index 38, all index 40, all these are my asset based standards. Same way there are certain standards which are dealing with liabilities part, so all those you can club it together, friends, right? Then income standards, like we have 115, we have got index 20, we have got, so all those are my income related standards. Same way we have expenses standards, right? So 102 is there, 19 is there, all are my expense standards, correct? So all those things you can club together, and accordingly you should actually learn how to apply those standards. So basically the first starting point is your framework. From there you learn what are my assets, what are my liabilities, and then based on that conclusion, rightly you have to first identify, and then you select your standard wherein you have to find the guidance for that. Okay, so this is how you should follow, and then I think that is the way you will never be wrong in whatever interpretations you do. Now having seen that what are my elements, now friends, the last part will be complete set of financial statements. So financial statement generally comprises of, which we all know, one is that balance sheet, then we have a statement of profit and loss. So here statement of profit and loss again is bifurcated into three parts actually. Basically it is two parts. One is a profit or loss, which is immediately followed by other comprehensive income, and the total which will give us a total comprehensive income. So everything together we have to present it as a one statement, that is statement of profit and loss. IAS may they permit two different ways, but under Ind-AS we are having only this one structure which is permitted. And then we have cash flow statement, then we have SOCI, the statement of changes in equity, friends. This is also very, very important area where we will see one or two examples that how people are doing. Then we have extensive notes, which we have covered actually, friends, that why notes are very, very crucial here and why disclosures are more. That I think we have learned when we started this. Note, you have to comparative information with respect of preceding period has to be mandatorily given, and a balance sheet as at the beginning of preceding period is required to be given wherever, as you must have under Ind AS 8, wherever you do some reclassification adjustments or prior period adjustments, or there is a accounting policy which you change, then always it says that it retrospectively it should be applicable. So in those cases, if that effect is going beyond the comparable period also, then you have to prepare the third balance sheet, which is at the beginning of the preceding period. So in those cases, friends, we will have three balance sheets. Okay. Now this is a general structure. I think we will not take much time here because we have already gone through in that schedule 3. But however, this is just the minimum line item. So Ind AS is very clear. It will not say that which item should come first, second, or something. Okay, it just says that this is how we said these are the items which minimally it should come on the face of the financial statement in your balance sheet. So that you have to take care, friends. And again, here you will find what is PP, what is investment property, what is intangible, what is financial assets, correct? Then what is biological. All these are guided by that particular standards which are applicable to those types of entities. There you will go and find out where it should fall, right? Ind AS 1 will not guide you here. You have to go there. What are my financial assets? Ind AS 1 will not find. You have to go to the financial instrument standards 10932. There you will find the answer. So friends, keep in mind this is very relevant. And again, as I said, we have guidance available under guidance note under schedule 3. Please go through that. Exactly you will know what they mean by financial liability, what are my other financial liabilities, what are not my financial liabilities, vice versa for assets also. So from there you will find what is the right treatment. Okay, so please keep in mind. Now one more part of my this standard which deals specifically, friends, is bifurcation between current assets, current liabilities, and non-current assets, non-current liabilities. So this generally will not find in other standards. So Ind AS 1 specifically deals with this area. Otherwise, as I said, all other parts specific standards deals, but classification between current, non-current specifically is dealt by Ind AS 1. So that's why, friends, here you have to be very careful to when you determine what is my current asset or current liability and what is, and as it is defined, friends, they are defining current assets and current liabilities. So what happens, whatever is not my current assets, automatically it will fall under non-current assets. Okay, so it is ulta. They have defined one area, so balance becomes my non-current. Same way current liability they have defined, so whatever is not my current liability will be my non-current liability. Only exception is, friends, Ind AS 12, which deals with deferred tax assets and liabilities. There they have specifically mentioned that irrespective of the whatever may be the definition of current and non-current, your deferred tax assets and liabilities will always be non-current. So that is what under Ind AS 12 they have defined. So otherwise you have to follow this principle and first see that based on the your transactions, nature of transactions and contractual obligations, you decide what falls under my current assets and current liabilities, and automatically balance will be your non-current. This is how you have to deal with. So friends, let us first have a look, because again here current assets, maybe you will find that it is easy to follow the classification for the assets part, but for liabilities part it is somewhat complicated. So there we have to be very careful. So that's why we will take few examples on determining the liabilities part, because that is very, very crucial. Now current assets they have defined is expects to realize the assets or intends to sell or consume it in its normal operating cycle. So anything which normally we deal with, like debtors, creditors, inventory, I think these are the items which generally fall under the first part, that I'm using it or consuming it, or I'm keeping it for selling or trading purpose. So, and this I'm going to do it in my normal operating cycle. We will see what is the operating cycle, friends. But then within that, if it is false, all these items, as we have seen, will be my current assets. Okay, assets which are primarily held for trading, then it becomes automatically my current assets. Okay, even though it may sometimes take more than 12 months to be actually sold, but still if it I'm holding that asset for trading purpose, then it always be my current assets. Third parties expect to realize the asset within 12 months after the reporting period. So if I have any asset which I am going to realize within 12 months after the reporting period, then I have to classify that asset as a current asset. And asset is cash or a cash equivalent. I think, friends, cash equivalent, I think they have defined under Ind AS 7. So anything which falls under that cash and cash equivalent will be my current asset. Other things will be non-current asset, right? And now coming to the current liabilities side, again, first part is very clear. If it is expected to be settled the liability in its normal operating cycle period, so if I have a trade creditor which I am going to pay off within my normal operating cycle, then that trade payable is my current liability. Maybe I have employee salary which I have to pay, employee bonus which I have to pay. If I am going to pay off within that normal operating cycle, then those liabilities becomes my current liabilities, friends. Then holds the liability primarily for the purpose of trading, so that becomes my again current liability. Liability is due to be settled within 12 months, same like asset part. If I am expected to settle within next 12 months, then it's my current liability. And the most important differentiator is, friend, this one does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. So if I have a liability which is there in my balance sheet, and it is there in my as on the reporting period end, and as per the contract, if I don't have discretion in my hand to defer the settlement of that liability unconditionally, right, for more than 12 months after the reporting period, then that liability will become current liability, friends. So this is very, very crucial. We will see a few examples so that it becomes very, very clear to you. Now presentation, friends, as we have seen, yeah, this again, that materiality, segregation, similar items, all those things you have to keep in mind when you make the presentation, right? And generally it is based on the current and non-current classification, unless for certain kind of NBFCs, if it is permitted by your Ind AS schedule 3, not that schedule 3 of division 2 or division 3, which may permit you to present in other way than current and non-current classification, then that is permitted, friends. Otherwise generally it is based on the current non-current classification which we have seen. Okay, now statement of profit and loss. Here most important part is, friends, that what comes under my profit and loss means profit or loss, and what comes under my OCI. So that is where you should be very clear. Okay, and separate disclosure they have defined that in notes for material items of income and expense, like restructuring cost is there, litigation settlements are there, then specifically the standard says that you have to give a separate disclosure for those items, right? Now OCI is actually from where this OCI comes, friends. Actually, again, as I said, OCI is other comprehensive which comes from the particular standards, because that standards will say when you have to take certain items not through profit or loss, but you have to compulsorily route it through OCI. So again, this that origination of this item actually comes from the particular index, like index 60. If you take example, wherever there is a revaluation, you do that, then that has to be routed through OCI. Or if you take the example of index 109, specifically they permits you to take certain items as accounting policy choice that you can route it through OCI. So those things come from that particular standard, right? Same way, you can take under Index 38, where again that revaluation is permitted. So you have to go to that particular standard, and that will say, you take the example of Index 21, which deals with FCTR kind of, whenever there is a foreign currency translation reserves, then it has to be routed through OCI. So this is where the Index 19 is there, remeasurement gain or loss, right, on employee benefits, actuarial gain or loss. So those things are actually dealt with by the standard, and there they will say that where and how you will present in the financial statement. And again, OCI shall be presented into two parts, that is items that will not be reclassified subsequent to P&L, and items that will be reclassified to P&L when specific conditions are met. So again, friends, these are all defined by the particular standards. So you have to go to that particular standard, and they will say, like for example, as accounting policy choice under Index 109, if an entity decides that equity, certain kind of equity investment, they will have a irrevocable, they will determine that it will be routed through OCI, then friends, it will never be reclassified to P&L, even if when they sell it, right? So that is again decided by that particular standard. Okay, you go to revaluations under Index 16 or 38, there they are very clear, it will never come back to P&L, right? So that revaluation reserve always will remain in your SOCI. Maybe at the end of the, when you dispose of that asset, it can just be transferred from one item to the other item within the SOCI, but it will never come back to P&L. So these are the items which will not be reclassified. But if you take the example of that FCTR, whenever that subsidiary, which is a foreign entity, if whenever you dispose of that subsidiary, automatically whatever you have transferred through OCI and it is sitting in the FCTR reserve in your SOCI will actually be reclassified to P&L when the investment in that particular foreign entity has been disposed of by the entity. So those are the items which be reclassified, right? Under Index 19, if you see actuarial gain or loss, it will never be reclassified. So this is how that, where to put it, it is again driven by that particular standard. You have to go to those standards. So Index 1 will not say this, right friends? So be very clear where you have to look for the answers, then you will never go wrong, and you will find that these standards are very, very easy to apply. Fine. So I think again, friends, these are all index you have gone through. So I'm not again going through this each item, because we will covering the other things in when we look at the financial statement. But yes, this is what, again, these are the minimum line items. The standard is saying, it will not say that this is how you have to present, which is the first item, which is the second item, but generally this is what the norms one has to follow. But we have a guiding factor in Index that schedule 3. So always you have to follow that. From there you will know which is the chronology in which you have to follow this. And yes, specifically they call it as exceptional items, or maybe items which are actually separate kind of items, which unless you disclose separately or present separately, users may not get to know exactly the purpose and what is the impact on the financial statements or the operations of the entity. That's why standard has specified that certain kind of items you have to separately disclose for the better understanding of the user. So right, examples are like write down of inventories of net reserve value, that is again covered by Index 2 also, friends. There also they are saying this has to be separately disclosed. Restructuring activity of an entity, very clear. If you go to Index 37, there they are saying that there is any restructuring kind of action you are taking, then whatever impact has to be separately provided also and disclosed also. Disposal of item of PP, yes, you can't merge it with, as I said, that whatever proceeds you get, you can't merge it with revenue. It is not your normal course of revenue, right? So disposal has to be treated separately. What is gain or loss on the sale of that asset has to be separately disclosed. Same way, dispose of investments, whether gain or loss on investment, dispose of investment has to be separately disclosed. Discontinued operations, specifically you have to separately disclose. litigation settlements you can't merge with like any gain or loss on litigation, but separately you have to show, and separate note has to be given that what is that settlement, and whatever provisions you have done, like write down of inventories you have done, and wherever there is a reversal of those write down, right, or maybe there is impairment which you might have carried out, and whenever there is a reversal of that impairment, then again has to be separately disclosed. You can't just merge with other items. So these are the specific circumstances with the standard has said that in such kind of scenarios you have to separately disclose the things. Now friends, again SOSI, which is again very important, and here you have to give the movement during the period. Opening mein kya tha, then what has happened during the period in that item, particular items which falls under the SOSI statement, and what is my closing balance. So like here generally we will find that all items which is routed through OCI, my profit and loss item which comes, right, then dividend distributions, or suppose there is a transaction between the two entities where I'm not losing my control over the subsidiary, then whatever transactions I do with the owners of, between the owners, that will be treated as owner transaction, and it will be routed through SOSI, and it will not be routed through your P&L. So this is another thing which generally comes here. And certain items like specifically covered by Ind AS 103 business combination, wherever actually there is a capital reserve, bargain purchase we say, and because of that instead of goodwill we are getting capital reserve kind of thing, so then directly it has to be taken to equity. This is how the things will come under SOSI. Okay, so and wherever there is a retrospective application of any prior period expenses or items which you are doing, and it affects your preceding period opening balance sheet, then it has to be directly taken to retained earnings instead of routing through P&L. So this is items which again falls under SOSI. So as I said friends, each particular standard will determine how and where you will present the things. So that comes from the standard. These are the guiding principles under Ind AS 1 friends. So plus most important is you should understand the standard. That is what I will repeat again and again friends, so that you will never go any wrong. Okay, again statement of cash flow, there is a separate standard friends, so that comes from there. So we have to be very careful what items where we present. Specifically after that 116 has come friends, so how to present those ROU kind of adjustments in cash flow, because in cash flow it is totally different way of presentation of lease liability related and ROU related items. So again you should be very careful how to present that. Notes, generally it should follow the presentation how you are doing in your balance sheet, P&L, so you should follow that so that it becomes easier for anybody to go through that in a systematic order, and you have to cross reference with the note number given in the financial statement so that it becomes again easier for the user to find out, and again go back and come back to and forth. So that's why it is important friends, right? And disclosure of accounting policy should always be at one place and should be clearly stated, and disclosure given in respect of the accounting must be sufficiently detailed that is understandable. खाली ऐसा लिख नहीं देगा as per Ind AS 2 I have followed inventory valuation. No, give details actually friend, how you are doing it, how you are doing recognition, how you are doing measurement. Please give in details friends, right? So now having prima facie gone through how things has to be treated, let us take few examples friend, and specifically when I said that important thing is how we classify between current and non-current, and specifically from the liabilities side. So let us see how this illustration has to be sorted out. In this example friends, there is a entity in December which entered into a loan agreement with the bank. The loan is repayable in 3 equal installments starting from December 25. One of the loan covenants is that an amount equivalent to the loan amount should be contributed by the promoters by 24th March 2021, failing which the loan becomes payable on demand. So this was one of the main covenants in the agreement, friends. So if you fail, then automatically that loan becomes payable on demand, even though it was a long-term loan, right? So it will have a repercussion as far as the classification into current and non-current, correct? And they have given as on March 25, the entity approached the bank and obtained a grace period up to June to get the promoters contribution. So they actually approached the bank before the year end, and they said that okay, please provide us the grace period up to June. And the bank agreed, okay, ठीक है, I provide you up to June. I will not demand that loan up to June, even if you don't contribute. But before June, you please try comply with this. Otherwise, I will demand that loan. Okay. So in this scenario, now we are reporting as on 31st March, friends. So what will be the classification of this particular loan as on 31st March? Based on the given facts that on 24th March, it was the last date when the promoters should have contributed. They have failed to do so. Subsequently, in the next day, they have approached the bank, and then bank permitted them a grace period up to June. So based on this scenario, what is your answer, friends, that as on 31st March, whether this loan will be treated as a non-current or a current loan? Yes, friends, actually it should be current, correct? Because even suppose up to June they have permitted, but that liability has to be minimum deferred for minimum 12 months after the reporting period. That in this scenario it is not done. So as on 31st March, you know that exactly if I don't fulfill by 30th June, this becomes my I don't have unconditional right to defer beyond 12 months. So this is how you have to see. So that becomes my current liability, friends. Now, second, they are saying that assume that in anticipation that it may not be able to get the promoter's contribution by due date, in February itself, the entity approached the bank and got the compliance extended up to 30th June for getting the promoter's contribution. So will this change your answer, friends? Yes, your answer will change, friends, because here there is no breach in the covenant in the first place, right? Because that due date was 24th March. However, before that breach happens, in February itself, the bank has agreed that okay, this 24th March ka date I am picking up and postponing it to 30th June. So here in this case, as on 31st March, there is no incidence of breach, right? So breach ही नहीं हुआ है, so I have a time up to 30th June to comply. So I can't go by what I am intention that what I am going to do in future, right? I have a time up to 30th June. So जहाँ तक वो 30th June नहीं आता है, that breach will never happen. So if breach is not there in the covenant, then that loan remains the same as it is when I have signed it. So it becomes my non-current liability. So this is how, friends, you have to keep in mind, because certain terms if you change, then your answer will change. So that's why I thought this example becomes important. Now here, friends, in this example you have to just tell me that these are the items listed which are part of my overall profit and loss. So whether it should be routed through OCI or it is to be routed through profit or loss account, that is what my question is. So first is remeasurement of defined benefit plans, friends. So here actually unfortunately we are not in the class to class type of arrangement, otherwise we could have interacted, but yes, friends, I will go ahead with the answers itself. So first should be actually it should be OCI, right? Because as per Ind AS 19 itself, it is very clear that they have said whatever remeasurement of defined benefit plans because of actuarial things has to be routed through OCI. Current service cost, friends, it will be actually profit or loss, right? Because it is my current service cost, so it will be debited to my profit or loss and not through OCI. Changes in revaluation surplus, as the item itself suggests, friends, it is dealing with the revaluation. So whatever happens to my revaluation things has to be routed through OCI. So that will be routed through OCI. Gains and losses arising from translating the monetary assets in foreign currency. What do you feel, friends? It should be profit or loss, correct? Because it is the time when I'm dealing with the foreign currency. Okay. So whenever I am accounting for that foreign currency in my books, that is the time actually I will route everything through profit or loss, right? Fifth one, gains and losses arising from translating the financial statements of foreign operations. So here I am not actually recording that item into my functional currency. Here I am actually, for the purpose of consolidation of my foreign entity to my parent entity, I am merging that entity with me, right, for consolidation purpose. So whatever that difference happens because of that translation difference, we treat it as a FCTR, correct? So this FCTR, gain or losses, will be routed through OCI. In Ind AS 21 it is clearly mentioned. So this is item which will be routed through OCI, friends, and not profit or loss. Sixth one, gains and losses from investment in equity instrument designated at fair value. Again, it is specifically mentioned, friend, in Ind AS 109, so that whatever in equity instruments you have decided to route it through OCI, so any gain or loss also will be routed through OCI. So that is again OCI item. The income tax expense is my normal expense, so that will be actually your profit or loss item. And then share-based payment cost, friends, again it is my cost of employment, so it is my profit or loss where it will be routed and not through OCI. So hopefully, friends, these two examples will help you in certain extent to clarify or how the things are happening, how you classify between current, non-current, and how you classify whether it is to be routed through OCI or not. But as I said, friends, keep in mind these items are dealt with by the individual standards and not Ind AS 1. So that is fundamental thing. Now operating cycle we have seen, because that is one of the items which is there in both the sides, current assets and current liabilities. So if it is within the normal operating cycle, then whatever items fall in that operating cycle will always be treated as a current assets or a current liability, friends. So that's why a company has a right to decide as accounting policy that whether by default my operating cycle is 12 months, or I can say that for this particular business my operating cycle is maybe 2 years. For this particular business my operating cycle is maybe 15 months or 12 months, whatever. So that is up to the entity, and then accordingly they can choose business wise, friends. It is not that entity level I can have only one operating cycle. So Ind AS 1 is very clear, you can have operating cycle dependent on your businesses, because if it industry is different, business is different, then your normal cycle will have to be different. It cannot be one, right? But if you feel that you have multiple businesses and it will be difficult to segregate everything based on that, then as by default you can say that 12 months is my operating cycle. So as a thumb rule, friends, in 90% of financials you will find that entity goes for default period of 12 months as operating cycle, but standard never says that this is what you have to do. You have a right to say that what is your operating cycle, you determine that, you disclose your accounting policy, and accordingly you can decide which items comes under current, which items comes under non-current. So keep in mind, friend. Okay, so there is no thumb rule. So in this case, they have given in the example that X Limited provides you the following information: raw material stock holding period is 3 months, WIP is 1 month, finished goods is 5 months, debtors collection period is 5 months. So the cycle from the procurement to the actual realization at the end, that is my operating cycle, right, friends? So in this case, they are said you are requested to compute the operating cycle for X Limited. So here all these items which are actually I am using in the consumption of my normal course of business, right, or for the sale purpose, right? So this all becomes my parts of operating cycle. So if you add all these things, you will find that 14 months is my operating cycle. So in this case, entity will define in accounting policy that my operating cycle is 14 months. So anything which falls under that 14 months will be my current asset or a current liability. Okay, even though it exceeds more than 12 months after the reporting period. Very, very crucial. So in this case, second question is the trade payables of the company are paid in 12.5 months. Should this be classified as current or non-current? So very simple, friends. Total is 14 months. So this 12.5 months falls within that 14 months. So my answer is that this trade payable is a current liability. Okay, but however, friends, keep in mind wherever your normal operating cycle, you are deciding that it is more than 12 months, then Index specifically says that okay, for accounting policy you will treat in the when you present it in your financial statements your assets and liabilities based on that normal operating cycle as a current or non-current. However, in the notes, suppose in the notes in this case itself, my trade payables in the financial statements, I would have taken this as a current, right? Because it is not within normal, but it is actually exceeding 12 months, correct? So in the notes part, the standard says there, irrespective of your choice of normal operating cycle, which may be maybe 36 months also, but in the notes part you give breakup of that particular item, that how much out of this total which you have reflected as a current is expected to be realized within 12 months, and how much is out of that which is realized expected to be realized after 12 months. So this is mandatory, friends. In the notes you will have to give that breakup also. Okay, so there many people are making mistakes, but standard is very clear, you have to give this. Now here, friends, again that covenant of loan, actually this standard is so big, friends, that so you can find that already we are approaching our timeline which is allotted to me, but Index 10 is very small, friends, so I hopefully we will be able to give justice to both the standards. So illustration 4, an entity has taken a loan facility from bank that is to be repaid within a period of 9 months from the end of the reporting period. Prior to the end of the reporting period, the entity and the bank enters into an arrangement whereby the existing outstanding loan will unconditionally roll into new facility which expires after 5 years period. So here, friends, before prior to the end of the reporting period, they have entered into an arrangement so that 9 months का जो loan था, automatically now it has been unconditionally rolled out into a new facility which will expire after 5 years. So in this case, how should such loan be classified in the balance sheet of the entity? Answer is very clear, friends. It will not be current, because before the period ending, there is an arrangement which has been entered into within the bank, and because of that, the entity has now unconditional right to defer the payment beyond 12 months. So it becomes a non-current liability as on the reporting date. Will the answer be different if the new facility is agreed upon after the end of the reporting period? Yes, the answer will change, friends, because in this case, as on 31st March, you were not having that control to classify that loan into that, and whatever you are going to do in future, that is not covered. So that will be a non-adjusting event, friends. So that becomes a current liability. It will not be a non-current liability. And under part C, will the answer be different if the existing facilities from one bank and the new facilities from another bank? Yes, of course. Again, it will be current, because it is like repaying the old bank and taking the loan from the new bank. So as far as your liability to the old bank is concerned, you will have to repay within 9 months. So your status is current, friends. So this will not make any change in the answer. So it will become a current liability. And in the fourth case, if the new facility is not yet tied up with the existing bank, the entity has the potential. So here the standard is very clear. What is the potential? You ignore. What is the facts? Whether entity as on the reporting that has an unconditional right to defer on their own. Unconditional means you are not depending on that other party. So here potentially you may feel that okay, I will approach the bank, and maybe there will be a scope of refinance. but as on the reporting that bank has not agreed, so entity does not have unconditional right. That's why that answer will be it's a current liability, friends. So please keep all these things in mind because this is very crucial, friends. Now other disclosures which may directly not affect your financial statement, but because it are important from the user's perspective, so the standard says you have to give a separate disclosure. The amount of dividends proposed or declared before the financial statement are approved for issue, that has to be given as a note. The amount of any cumulative preference dividend not recognized has to be separately disclosed. The legal form of the entity, its country of incorporation, and address of the registered office, that has to be. If you take any example, friend, any annual report, you will find the first item which starts with that company information. There they mention that what is the kind of entity, when it was formed, which is the country of incorporation, what is the address of its registered office. Please look at all these things you will find in the any balance sheet, and then you read this standard along with the keep that balance sheet in front of you, compare each item. That way actually it will be very easy for you to grasp the requirements of this standard, and you will be able to easily comply with the requirements. Okay, nothing will be missed out. A description of the nature of entities operations and principal activity, that also I think in company information people give the name of the parent and the ultimate parent of the group. All that structure actually generally they give in the company information. It is given. And in case of a limited life entity, information regarding the length of that life has to be disclosed separately. So this is how separate disclosure is required, friends. Now comparison between international standards, major I think one or two disclose carve outs are there here. Ind AS 1 allows only the single statement approach of profit or loss, other comprehensive income, as I said, but in IAS provides an option that either I can go by single statement approach or I can follow two statement approach. So there in that case there will be a separate statement of profit or loss, and there will be a separate statement of comprehensive income, right? So these two will be a separate statement itself. But Ind AS said no, we will have only single statement approach to make the life easier, and within that only there will be two parts, profit or loss and other comprehensive income. Another carve out is Ind AS 1 clarifies that in case of loan liability, if any condition of loan agreement which was classified as non-current is breached on or before the reporting date, such loan will not be classified as current if the lender agrees before approval of financial statement not to demand payment as a consequence of breach. So suppose in this case, in that example, there was that covenant that you will have to bring in that promoter's equity, right, within that date, and you could not, right, and there was a breach of covenant, or maybe that you have to maintain certain kind of ratio, okay, and that ratio, equity liability, that debt equity ratio has to be maintained, or maybe a net profit ratio has to be maintained. These were the part of your covenants, and that is on the reporting that actually there was a breach into that covenant, correct? However, when you approach the banker and asked him that please waive those covenants, okay, so that you will not treat it as a breach, and it will be like your normal thing. And if that waiver correspondence letter, right, from the lender is received before the financial statements are approved, and that letter specifically says that I will not treat this breach as a breach, okay, and I will not demand payment of that loan unconditionally, then even though there is a breach, it will not be treated as a current liability. You will be continuing to treat it as a non-current liability. However, IAS 1 is very clear under IFRS, friends. Then wherever there is such a breach, and if that banker has not given their waiver before the end of the reporting period, then that will be treated as a breach, and it will have to be reflected as a current liability. So here is very important, even on 1st April, suppose the banker agrees to waive, then also under IAS you don't have any choice. It has to be before 31st March. That banker has to agree, and that communication should be there before 31st March. Otherwise, under IFRS, that loan will be treated as current only. Here, this is main by this carve out. Under AS, friend, you know, AS only deals with disclosure of accounting policy. It does not deal with the presentation. So very narrow. Here, as I said, Ind AS has an extensive disclosure that guidance on how to treat classification of current and non-current. AS, because it deals only with accounting policy, again that is not there. Most important, under Ind AS, you can't have an item which is extraordinary, but under AS we have found many places still people were using item as an extraordinary item. Under Ind AS that is not permitted. You can have exceptional item but never extraordinary item. This is not permitted. Another important is requires classification of expenses based on nature of expenses, but under AS1 there is no restriction. You can have even on the basis of other than nature. Like under IAS they allow you to have function wise also expenses instead of nature wise, but here under Ind AS they say function wise we will not allow, only nature wise expenses. Okay, so friends, let us deal with Ind AS 10, and then maybe 5 minutes we can deal with the balance sheet, how they are presenting. I know Vishal bhai 5+ minute આમ તેમ ચાલશે, because already I have approached 1 o'clock.
ચાલશે રાજેશભાઈ, ચાલશે.
Thank you, sir. Thank you. But I will try to do it as early as possible. So Ind AS 10, events after the reporting period, friends. Yeah. Here, main principle is that any things happens after the reporting period, but up to the time when the financial statements are approved for issue by the authority, within that period, whatever events happen, whether it is favorable or unfavorable. So here this standard deals with both the things, friends, whether it may be favorable or may be unfavorable. Both they define that has to be taken care, either based on the principles, whether it will be treated as an adjusting event or non-adjusting event. That is the only thing we have to determine. Otherwise, this is the period which is covered by this standard. Between reporting period and the date of approval, whatever happens, which are material events which has happened with the entity or outside the entity, and which has an impact on the entity, whether favorable or unfavorable, has to be either disclosed or is presented, means given effect and disclosed, right? So that depends on whether that event fulfills the criteria for determining whether it is adjusting or not adjusting. Otherwise, disclose तो करना ही है दोनों केस में, compulsory. Only thing is effect करता है कि नहीं में balance sheet or not, that determines based on the how we deal with that item as a adjusting event. Okay, बाकी clear है कि you have to disclosure तो देना ही है. Okay, and special cases how to deal, right? Long term loans arrangements में जैसे हमने देखा current हो गया तो क्या करेंगे, non current हो गया तो क्या करेंगे. Going concern are very relevant, friends. Here we will see one example because that is crucial. That's why special cases में ध्यान रखा है, right? So let us go through this, friends. So the objective is, friends, when an entity should adjust its financial statements for events after the reporting period and the disclosure. Okay. Scope, these standards shall be applied in accounting for and disclosure of events after reporting period. So this only deals with whatever happens after the reporting period. Now they have defined events occurring after the reporting period as adjusting events when they provide evidence of conditions which existed at the end of the reporting period, so that adjust the effect of such events in the financial statement for the period. So if it provides evidence that what is already existed on the reporting period, then you have to adjust your financials. Otherwise you are falling under non-adjusting events. So they have defined non-adjusting events as events that are indicative of conditions. Okay, so that condition was not existing on the reporting period, but it is indicating of the conditions that arose after the report. So reporting period में वो condition था ही नहीं, that has happened post the end of reporting period. Then these are my non-adjusting events. So do not adjust the financial statements, but disclose the impact if it is material. So if it is material, then you have to disclose even though that event has happened after the reporting period and it is not affecting my financials. So that period actually we have seen how which period the standard covers. So that is crucial, friends. Okay, and here I will only tell one thing, that NFRA which has come out with this report, there I think for events after the reporting period, they have even gone to the extent कि shareholder approval तक कुछ भी event ऐसा हुआ है, maybe from they were talking from mostly fraud angle and all those things. So they are saying that even those period can be treated for the purpose of change in the financials. If the auditor comes into it comes to the knowledge of the auditor, even after it were issued for by the authority, but till the time it was not actually adopted in the shareholders meeting. So वहां तक का period भी NFRA said that why not to cover that period also. So we have to be very careful, friends, going forward, because in the way they are now treating us, the way they are actually coming out with that amendments in the audit report, amendments in the schedule 3, everything has actually directly come out from that ILFS report which NFRA has given. So if you have time, then I would request you all to go through that report line by line. You will understand how NFRA is going to look at our role as an auditor and how much responsibility they expect that it is within our framework, and it is not something they are asking you to do some favor, right? They are saying it is your part of duty, you have to do this way only. So please go through that report. It is very, very important. You will know how the things are going to be in future. Now in this case it is self-explanatory, friend. If these are the dates, then which will be the date to be treated for the purpose of events after the reporting period? Here 5th May is the date. So anything which is happening from 1st April up to 5th May, that is the period which will be covered by the standard for the reporting. Now certain examples, frame. Adjusting events are settlement of a court case with any which is happening with the department, any authority, or any other legal suit which is going on between any competitor, and already in the books of account you have make some provision on that, and that settlement of court case which is happening after the reporting period, then it becomes fair adjusting event because that there was existence of that item as on 31st March, right? Then bankruptcy of a customer. Suppose a customer के साथ आपका dispute चल रहा था, या maybe that customer was not paying regularly, so you have made some provision on that receivables, and then after the reporting period, if that customer becomes bankrupt, then it will become adjusting event because already you were knowing as on 31st March and you had provided for certain doubtful debts relating to that customer. So now because वो पूरा bankrupt हो गया है, तो maybe you must have provided maybe 50% as on 31st March, but after the reporting period, when you come to know that he has become bankrupt, so go back, make 100% write-off of that customer. So that becomes your adjusting event. Discovery of fraud, as in the case of NFRA, they have said fraud कभी भी मालूम पड़ा even after the reporting period, but if it is affecting your financials, then that financial will never be true and fair. So go back, make adjustments, and give that effect of fraud in the financial statement itself, right? Same way COVID-19, anything which has affected, and that situation was existing as on 31st March, and because of COVID-19, any event which catastrophically affected your industry, then you can't avoid, you will have to give effect, because there may be going concern effect also it will come. So those becomes my adjusting events. So some examples of non-adjusting, like destruction of plant by fire. You may have many plants, right friends? One of the plant there is a fire, so maybe because of that your existence will not come into question mark, right? You will continue as a going concern, but because there is event which has happened, which is maybe not that destructive as far as your going concern is concerned, but yes, your shareholders or users should know that such thing has happened, so it becomes non-adjusting. However, you are having only one plant, and your existence would have been a question mark if that plant would have completely destroyed by fire, and so that you will stop continuing as a going concern, then it will be shifted from non-adjusting to adjusting. But however, it is one of the kind of plant, and you have other many plants, and it is not material enough to impact, then it's a non-adjusting event, and you have to disclose. Decline in market value of investments, there is nothing to do as on position as on 31st March, it has happened afterwards, so it becomes your non-adjusting events. A major business combination or restructuring which you have taken up after the reporting period, then you have to disclose it, it will not affect your financial statements. Abnormally large changes in asset prices or foreign exchange rates, again it is not the situation which was having as on 31st March, it has happened after that period, so again it will be having only a disclosure, no need to adjust in the books. Okay, here that NRV, so here you go to Ind AS 2, there they are saying very clearly that as on 31st March, when you value your inventory, you have to check for the purpose of NRV what has transpired after the reporting period, at what amount you are able to sell your product, and if there is a reduction in the sales price, and so that you are not able to recover your cost also, then the standard is very clear, you have to go by whichever is lower. So this will become an adjusting event as far as the inventory measurement and valuation is concerned, friend, because you can't ignore that. Now in the second example, there is an installation which has happened of the machinery, friends, and the installation was also made and it was ready for the intended use on 15th March. However, that installation ka bill which was to be received from the supplier who was actually given that order of machinery as well as installation, that he has sent the installation bill only on 10th April, right? So whether those bills I will have to book it in 31st March as an adjusting event, or I will have to book it in the next year? The answer is very clear, friends. Actually installation has happened, so my plant has been ready for intended use before the year end, so only that so existence was there as on 31st March. Only thing that final bill has come on 10th April, so I will have to go back and take that bills in the March itself, so it becomes my adjusting event. So how we differentiate, friends? So this guidance table will guide you timing of event, during or at the end of the reporting period, then it becomes adjusting. Whether there is evidence as on 31st March, yes, then it will become adjusting. Accounting treatment, adjust the amount. Okay, disclosure, yes, as I said, whether it is adjusting or non adjusting, दोनों केस में disclosure तो common है, आना ही चाहिए. Now timing of event is suppose after the reporting financial year, then it becomes non-adjusting because it was not having that as on 31st March. Legality, it may just be indicative, right? Because it has happened after the reporting period. Accounting treatment is no, do not adjust, only disclose. So this again, I think, friends, it will help you that when that breach has happened, whether it will be treated as a current or non-current. So I'm not again going by, we have covered that example. Same thing, minor default है अगर covenant में, You have to timely time support. Suppose submit your bank back to the bank your inventory statement, debtor statement, और उसमें थोड़ा यहाँ हो गया तो then they may call it as a minor default. So even though there is a breach, आपने delay कर दिया है, but it may not affect that your classification. You will continue as a non-current liability. But if it's a major default, then in that case you must have that waiver letter from the lender, right? Otherwise it will become a current liability. Yes, going concern, friends, as I said, very relevant. These are the guiding principles that when it will be treated as a non-going concern, right? Third, that has no realistic alternative. That is very important. So that keep in mind, because of COVID ऐसा आपको बहुत सारी balance sheet मिलेगी जिसमें possibility of this will come. So standard is very clear that you have to give the fact that it is not prepared on going concern, basis of preparing, and reason why entity is not regarded as a going concern. Okay. Dividend, yes, we all know previously, even though it was proposed and not declared, we were giving effect in the financial statement going back in the year in which, for the year in which it was related. But now you have to just disclose. You can't go back and give it becomes a non-adjusting event, friends, right? So that is you have to disclose that. But redeemable preferences, as we have seen, friends, under index 32, if it is a redeemable preferences, so that it becomes my financial liability as per 32, then even though dividend is not declared, okay, but as a rightful holder of that financial liability, I have a right on that preference. Suppose it is a non-discretionary dividend on redeemable, then we have seen that both items are financial liability. Then I have a right over that dividend as a akin to interest. So I will have to provide in the books if it is that kind of redeemable preferences which are non-discretionary. Okay, so even though I have proposed the dividend not declared, but because it is non-discretionary, I will have to provide for that dividend in the book, so it becomes an adjusting event. That is very crucial. Another you will find in all the balance sheet, specifically you have to mention date of approval of issue, right? Major non-adjusting events and उसका possible impact क्या होने वाला है, that also you have to disclose. So these are all disclosures which is covered under index 11 index 10. Now one more example, friends. ABC Limited is in a legal suit with GST department. The company gets a court order in favor on 15th April, which resulted in reducing the tax liability on March. The final statement were approved on 15th May, but manager considered that favorable things I have to ignore, and only if it is unfavorable, then I have to give it becomes adjusting event. So in this case, friends, if that because of that court case, that finality has come to your in your favor, right? And you know that it is a final thing, and there is no other recourse to the department, then in that case it becomes adjusting event, and you will have to give effect to in the books. But however, as I said, if recourse is available to GST, then it becomes uncertain event. You don't have control over that. So maybe then you have to wait, which is defined as we call it as a contingent asset, friend. Then maybe you may not take it into accounts. So then in those cases, it can become a non-adjusting event. But however, if it is a final order and there is no more recourse, then maybe it becomes a adjusting event. This is how we will have to look at it. Again, this is the case of NRV, friends. It comes from index 2, so I think this also becomes my adjusting event. Okay, so I will have to treat that laptop at 35,000 and not at 45,000 for the valuation purpose. So what I will do now, friends, that I will take up one or two balance sheets for just 5 minutes, and then we can deal with few questions which may be there. And then and I assure you that whatever questions I am not able to reply now because of lack of time, I think we can, I will give it in writing to the institute, and then they will put it in the website for your benefit. The lifetime which I have done for that 32. Okay. So yeah, this is one example of changes in accounting policy. This is the Jai Prakash Associates balance sheet, friends. So you will find note number 65, that is changes in accounting policy, which comes up from Ind AS 8. So how the company has dealt into, because they are saying that because of that 116 coming into play, they had adopted a new accounting policy, maybe under the transition provision, because you must have seen under Ind AS 8 that how to deal with that accounting policy change, maybe because of the new standard, then there is a transition provision within that standard, then you have to follow that provision, but disclosure has to be made. So in this case, they have given a detailed disclosure that because of this 116 coming into play, how they have dealt with that accounting policy change, how, what, whether practical expedients they have applied as per the standard transitory provision or not, how it has impacted them, everything they have given detail, friends. So that's why I thought that this is a right kind of presentation which has to be given, and they have given the adjustment recognized in the balance sheet, means on 1st April 2019, because they had gone for modified retrospective effect. So not going back, but in prospectively, but affecting my opening balance sheet. So retained earnings में क्या impact आया है, that I think they have provided. So if you see that right of use assets की वजह से what has happened, lease liability what has happened, security deposit की वजह से क्या change आया है, and that total impact, that 250, right, that they have given. So that is the total impact in lakhs, 250 lakhs, because of this accounting policy change because of 116. So that's why I thought let me give you this presentation. Now I will take another example, friend. Yeah, this is Reliance Communication Limited ka balance sheet, friends. So here see, I would request you to read that material uncertainty relating to going concern para, which is there in qualified opinion. So there, because I thought that going concern becomes very relevant, and that's why I thought let me pick up this balance sheet. So here the auditor has already considered that there is a material uncertainty which is there as per SA 570, and they have defined that even though there is so much thing, they have continued to go as per going concern. So this is what the auditor has reflected, and in the notes to accounts, management will have to disclose, because that is the requirement as per our Ind AS 10, that on what basis you are saying that it's a going concern, even there are the material discrepancy, material uncertainty, then also you have to provide disclosure. And this is just a balance sheet presentation, friends. How whatever we have learned today in Ind AS 1, people are doing. This is SOCI. So here you will see capital reserve, securities premium, general reserve, reserve for business restructuring, debenture redemption, retained earnings, correct? So all those FCMI TDA, okay. Then other OCI may say that remeasurement of defined benefit plan. So all those which we have dealt in under SOCI. So this is how generally it is presented, friends, in the segment of other equity, and equity plus other equity, we call it as a statement of changes in equity, SOCI. So this is how they are doing. This is the example of cash flow. So we are not going into detail, friends. And this is how the general information, as I said, it will give where it was registered, when it was registered, what is the registered office address, so what is required by the Ind AS standard one, everything they are giving here. Then they are under that CRC process, NCLT पे चल रहा है. Then basis of preparation of financial statement, that they have given, correct. Then here they also give that current non-current classification kaise kiya hai, that also they give. Then recent accounting developments which they have given, right? Then these are all my specific estimates, judgments. As we have seen that whatever judgments management is taking, on what basis they have taken that judgment, all those things has to be reflected, that we have covered, friends. So this is how people are doing it. So please keep in mind, friends, this all comes from the relevant standards which is applicable. From there they are selecting the accounting policy, so they have to give details why they have selected and how they are going to affect them, right? So that's why I'm giving this. You can always go through. The measurement, yeah, right. So each standard will cover what has to be given. Now here that friend going concern. So we are actually interested here in this, that what management is saying, why, because even though there are so many uncertainty are there, material uncertainties, still they feel that the financial statement can be given on a going concern basis. So this is the detailed disclosure, friends, the management has given. So what they are saying, yeah, because they are in NCLT and they feel that new bidder will come, and that's why it is a going concern. However, since the company continues to incur losses, current liability exceeds current assets, and current company has defaulted, all these things are there, right? That's why these are material uncertainty. But they are only saying that because it is under NCLT and because of chances of restructuring is always there, that's why they are into IBC, and that's why they feel that even despite all those uncertainties, still they can continue as a going concern. So I think this was what was important as far as this standard was concerned, and I was referring to that going concern presumption and how it has to be disclosed. And as another point was there, authorization or financial statement that has to be given. And so that also they have given that they are under NCLT. So who has the authority to issue this approve this financial statement? So that is also again one of the requirements of Ind AS. So this note also you can refer anytime if you are dealing with any NCLT kind of IBC process kind of company. So there this disclosure will help you, friend. That's why I thought let me give you this. So hopefully, friends, this comes to an end of my presentation. If you we can take a few more time permits, we can take few questions, friends. And thanks for giving me a patience hearing, friends. And thank Vishal Bhai for giving me this opportunity to present myself in front of our colleagues, and they are so dear to me. Thank you.
Thank you, Rajesh bhai. Just one question before we sign off. Can a going concern comment form part of key audit matters?
Please come again.
Can a going concern comment form part of key audit matters?
Actually, see, if you compare this, there is a interplay between 701, 705, 706, and there is a 570, right? So generally, if I'm specifically dealing with material uncertainty as a under 570, then normally you will find that people don't give, because there is a separate and that is given a priority. So if you see, go through any report, 570 will have precedent. So first there will be a qualification or an opinion para, then comes my basis of opinion para, then you will find there is a material uncertainty para that is under 570 if I am reporting, then comes my key audit para, right? So if it is covered there, then generally you don't give that separately, because there is a separate standard which is applicable for 570.
Right. Thank you, Rajesh bhai. In fact, I would say that when I was structuring, it seemed that 1, 8, 10 would be easier to comprehend and discuss. But now I find that in spite of you deliberating for almost 2 hours, in fact, you were not able to extensively cover 8 because that was taken by Yagnesh bhai. So I was just thinking if you had to cover all the three, maybe it would be a full 3 hour session that would be required. So
Right,
friends,
sir.
what I was just hinting at that some of these standards which we feel are easy or which we typically I would say technically ignore because they don't form part of the actual recognition measurement principles, but they are very very important and they give us a lot of guidance which Rajesh bhai has aptly I would say even opened our eyes that these standards are more of guiding, but they are definitely very very important as far as India is concerned. Thank you, Rajesh bhai, for chipping in at the last minute and taking us through these standards in a very, very detailed manner and showing us the importance of these standards. Thank you very much. Friends, just one announcement that on 1st April, we have kept a session on the recent amendments to the Companies Act that have been brought out with respect to the audit trail, with respect to the audit report, and with respect to the Schedule 3. So you can log into the WRC website and register yourself for that event. It is 5 to 7 p.m. on 1st April. And I would take this opportunity to thank all the participants without whose support this refresher course would not have been a grand success. We had 4 extensive days, I would say Sunday mornings of deliberations and Rajesh bhai, let me be very honest that we have overall got a very positive feedback from all the participants, and the question answers itself reflect the quality of the deliberations and the quality of the members participating. So thanks to all the participants, thanks to all the faculties, thanks to Mishra ji, Vaibhav bhai, Subhash bhai for all the support at the back end. Thank you, everybody, and we shall keep meeting in the future events. Thank you. Thank you, everybody. Bye bye.
Right. Thank you. Thank you. And wish you everybody a happy Holi. And hopefully we have a match, one day international match also today. So maybe the later part of the day you can have an entertaining session and enjoy the match also. Hopefully we win the series today. Thank you. Thank
Yeah,
you.
exactly. True, true. Thank you. Thank you. Thanks, everybody. Bye. Bye.
Bye. Bye.